we're probably going to see persistent inflation and that these yields are not all overdone.
The real worry is not only about this winter shortages, but also next winter shortages.
We have an almost abnormal obsession with all things inflation.
For the most part, what we're seeing is the consumer's okay.
People continue to have a pretty high cash coffer.
This is Bloomberg Surveillance with Tom Keene, Jonathan Ferro, and Lisa Abramowicz.
Good morning, everyone. Jonathan Ferro, Lisa Abramowicz, and Tom Keene. It's a Friday on radio, on television. We continue today, a special surveillance. Maybe we'll do normal hours today, not like we did yesterday. Thank you all for your comments on our coverage of the resignation of the Prime Minister yesterday. Today, we don't care. Lisa, it's the bond market. Let's reset. It is unreal.
And they are connected. The bond vigilantes are taking over. They are coming out in force. We thought that perhaps we'd seen peak hawkishness, perhaps we'd seen peak yields. That was not the case. Yields around the world, whether the U.S. or Germany, surging to multi-decade highs, at least according to what we're seeing in some places, or a decade highs. And how much does this reset expectations and valuations? Let's
reset with Garfield Reynolds of Bloomberg News. He goes back to 1984. And you've led on this, Lisa. It's not about the level of where yields are and that. It's been the persistency of the lift. This distraction, that distraction, the midterms coming up. Forget about it. The persistency of the yield lift is the story of this October.
Well said. And what we're seeing is the longest streak of consecutive weekly increases in yield, declines in price for the 10-year Treasury. How much does this reset the understanding of where equity valuations are? We were talking about resilience in the face of earnings. How much does that change simply because the yield equation doesn't give them that freedom?
And there's this talk of Powell and Volcker. We're going to have Steve Major with us with HSBC in the 8 o'clock hour. That's must listen for Global Wall Street. But Lisa, what's so important here is with the 10-year yield, 12 weeks higher yields back to 1984, that sort of edge of that historic Volcker moment of about 81, 82.
And raises issues about whether Larry Summers, whether Bill Dudley, whether they were right. Whether the yields can go that much higher than many people ever thought was possible because the markets haven't broken, because we have seen inflation continue to surprise to the upside, and because of the global nature of a sell-off that has a persistency we haven't seen in an entire generation.
My level for you house hunting this weekend, if you're done with your leaf peeping, let's go look at a house.
Oh, thanks.
It's marked down. 7.32% is my bank rate 30-year mortgage. What level do you use, Lisa, as your benchmark yield as we go into the weekend?
The Mortgage Association, having that as one. I'm just looking actually to take a page out of your book, leaf peeping notwithstanding. Real yields, to me, are really speaking volumes.
Really
the fact
stunning.
that 1.76% on the 10-year, this is adjusted for the market expectations for 10-year inflation. How much are we looking at something that is unsustainable? I remember speaking with a couple of investors who thought that 1.5% was the line in the sand. Well, we've blown through that and keep climbing.
What we're also doing, of course, and thank you to Anna Edwards on the green. I believe we're going to go there in this hour. This is the reality. There are a selected group looking at a selected airline which has a selected former prime minister on it, supposedly landing at LHR right now. Now, I don't want to say that's happening, but that's the speculation.
Are you talking about Boris Johnson?
It's a selected
exactly.
It's a previous prime minister who resigned, which I think is it 8 prime ministers?
Okay.
Yeah.
So
George Canning is not on that airplane.
George Canning, for those who don't know, died in the early 1800s and was the second shortest serving prime minister. Otherwise, this is really an anomaly. How much are we looking, though, at, and I keep going back to this, yes, this is UK specific. Yes, this is turmoil. You could say this is spurred in part by Brexit. You could say this is spurred by the energy crisis and also the inflationary environment. How much is this an example of what we can expect of the bond market taking control, markets really in the driver's seat at a time when governments are not used to not having their backs? And you have, meanwhile, central banks that are not going to finance the deficits by simply buying all of the debt issued. This is a game changer. How much does this change the political environment globally?
Let's do a data check, do a brief, and get to a true foreign exchange expert. I'm going to talk with the collapse of sterling. It's down one big figure, 111.21. A 110 print's a big deal. Anything through 1.1000 is a huge deal. Dollar stronger, DXY back above 113 gets my view here. In yen, 151. I'm going to round it up. 151 is stunning. We'll talk about that in a moment. Futures a bit negative here. The VIX goes nothing for the week, 30.16. We had a 29, for a whisper there, we had a 29 on the VIX. And the yield, as we've been talking about, pick your yield. I go with the 10-year yield, Lisa, 4.27%.
All right. Well, today we're looking at the last slew of Fed speak before the quiet period. The quiet period beginning
Thank God
next
for
week.
the quiet period.
Right. So we're going to get possibly Charlie Evans. We're not sure at 9:40 a.m. He's the Chicago Fed president, but John Williams, New York Fed president, will be speaking at 9:10 a.m. We'll be speaking throughout the show, but just as a side note, I'm curious. We speak about all the Fed speak. Jim Bullard, kind of in a bit of hot water with question marks around this off-the-record event at Citigroup, and some people wondering. He's saying he's not going to be doing any more private events. Earnings continue today. American Express and Verizon Communications within the next 90 minutes or so. The earnings that we have gotten have been, I guess, some strong, some weak. And this really highlights the bifurcated nature of the physical goods market, as well as some of the services that continue, like that airline, that flight perhaps carrying a former prime minister.
You wonder how British Air will do, with all their troubles through the pandemic versus what we saw from United and American Airlines as well.
And just one final note.
Please.
In Brussels, European leaders will be gathering to talk about the energy crisis. And we have seen energy prices, natural gas prices come significantly. What do they say about the United Kingdom? What do they say about where their hands are tied in terms of how much fiscal support they can provide?
The prices come in on gas from the hysterics of a couple of weeks ago, and I think it's worth studying over the weekend. I mean, everyone's weekend reading is going to be incredibly rich here, just starting with the politics of the United Kingdom. But again, I'm going to go back to folks today. Our real focus is going to be on bonds. Steve Major of HSBC will join us in a minute. Futures negative 18. Mark Chandler has written books on the astrology of foreign exchange, the interdependencies, nation to nation. He is chief market strategist at Bannockburn, and we start strong with Mr. Chandler this morning. Mark, let me go to Global Wall Street and what everybody wants to know. When is the comfortable time for Ministry of Finance in Japan to step in on 151 yen? Did they do it now? Did they do it in the quiet of their weekend? Or did they wait for the Asian Monday morning, our Sunday, 7 p.m.?
Yeah, it's a great question, Hatam, after they intervened at the end of last month. And I think they did three things that make the intervention less than successful. First, it was not a surprise. They continued to warn the market they were planning to intervene. Secondly, they did it unilaterally. That is, there's very little support from whether it's Europe or the United States for BOJ intervention. And the third thing I think they did is by intervening, they did not signal a change in policy. And so what we were telling our clients was that the only thing worse than intervention was failed intervention. And I think that's what's happened. Yeah. And so I think the Bank of Japan's in a tough position. If they do intervene, it probably won't be as successful as a last bout. They spent $20 billion practically to get maybe a week's night worth of pleasant sleep.
Mark, the Chandler word for acceleration, for a rapid advancement, is convexity. There's clear convexity in the unraveling of Japanese yen, Turkish lira, and that. Do you anticipate a fourth quarter and into 2023 of acceleration in these trends, or can we find stability?
Yeah, that's a $1 million question there, Tom. I think that the dollar is close to a top, partly because I think that Fed policy, as the market's got it priced in, they're 5% now. That's a 75 basis point hike in early November and again in December, and another rate hike early next year. I think that inflation is close to a peak, even if the core rate is too sticky. I think here's what I'm looking at.
Please.
Q1, the annualized rate of CPI was over 10%. In Q2, the annualized rate of U.S. CPI headline was still above 10%. Q3 fell to about 2%. So I'm looking at inflation to be coming off. I know that it's very controversial right now. I know many people have been burned calling for this before, but I think that we're coming to the tail end of this historic dollar move. And I think the Bank of Japan and the PBOC, the Central Bank of China, are basically playing for time until Fed policy peaks, until the market brings the dollar back off of these historic levels.
Does this mean simply that it doesn't matter what happens in Europe, that this is entirely a Fed story from your vantage point and peak inflation in the U.S., and that it's not necessary to see a material turning around in a European region that seems like it's heading into a really difficult moment?
Yeah, so I agree with that, Lisa. I think that for me, there's two big drivers here. One, of course, Fed policy. Everybody Everybody knows about that. I think what's less appreciated is that there's been a serious deterioration of Europe's trade balance as well as Japan's. So the deterioration of the external accounts, as economists would call it, I think is another factor weighing on the currencies. But I think in the most immediate sense, that if the Fed were to announce today, maybe a Fed speech says we're done, I think you see the dollar come off very sharply.
Mark, you've just driven the 10-year real yield ever higher. Rounded up, we're up at 1.78%. We've moved mightily, like 88% to my study of 2.05% is somewhat of a normal 10-year real yield. Where's your number on that? What is a normal 10-year real yield?
Yeah, tell you the truth, I don't have a clue. And I say that because I say that partly because, these things like a real yield, R star, you can't touch them. They're sort of they're abstractions. They're statistical abstractions. And I think that when you look at Fed funds rate, which is really what I focus on for the real rate, I think we're still looking at a negative real rate on Fed funds. And typically, looking for a little further out to the 2-year, you get a positive 2-year yield, real yield. And we don't have that yet. But I think this is a different cycle. And I think that because it's an unusual cycle with all these shocks, whether it's COVID, whether it is the supply shocks, whether it is Russia's invasion, I'm just not sure that these benchmarks are very useful right now.
This is really, really important, folks. This is why we have Chandler leading off today, because A, he does not have a clue. There's no question about that. And also, he moves away from the usual statistics and looks at a benchmark for Chandler and Bannockburn of 2%. That was brilliant.
I think that should be our mantra. To tell you the truth, I don't have a clue. So you'll
Pharaoh
come to
tells me that on the day. Where is Pharaoh? Is Pharaoh coming back?
He's not coming back because you said he's playing footsie with the Dow. And he said,
Hey, Zero Hedge quoted from his paper last night. I thought it was pretty good. Appendix 6, futures negative 21. Yes, we will speak of London. We are going to go to Parliament here as the quick battle heats up for a new Prime Minister. Stay with us. This is Bloomberg.
Keeping you up to date with news from around the world with the first word, I'm Kaylee Lyons. Ukraine's foreign minister says he talked with Israel's prime minister about Kyiv's request for defense systems to help combat Russian missiles and Iranian-made drones. Israel has offered to assist Ukraine with a missile warning system, but says it will not provide weapons. The U.S. has accused Tehran of sending trainers and technicians to Crimea to support Russian drone attacks. The European Union has agreed to press ahead with a set of emergency actions to address the bloc's energy crisis. It comes after Germany yielded to pressure from other member states to pave the way for a temporary price cap on natural gas. The European Council's president says the move sends a clear signal to the market that the bloc is ready to act together. The Biden administration is said to be discussing whether the U.S. should subject some of Elon Musk's ventures to national security reviews. Sources say that would include the Twitter deal and SpaceX Starlink network. U.S. officials are uncomfortable with what they see as Musk's increasingly Russia-friendly stance and his plans to buy Twitter with foreign investors. Adidas has issued a fresh profit warning as unsold goods pile up and consumer demand weakens across China and Western markets. The German sportswear maker says it now expects an operating margin of 4% this year, down from a prior forecast of 7%. The CEO, Kasper Rorsted, has already announced he's stepping down next year. Global news 24 hours a day on air and on Bloomberg Quick Take, powered by more than 2,700 journalists and analysts in more than 120 countries. I'm Kaylee Lyons. This is Bloomberg.
We've seen the power of the markets over the last few weeks. I think Chancellor Jeremy Hunt was getting on top of that, putting together a package that would have been reassuring to the markets on the 31st of October. Clearly, what we mustn't do now is anything which signals to the markets more chaos, instability and uncertainty.
From the time of Theresa May, Lord Hammond, he's the former Chancellor of the Exchequer for the United Kingdom, with a view on his party. There are many views this morning, to say the least. It is a movable feast. And again, we say thank you to our team, and particularly to John Micklethwaite, our editor-in-chief, for wisdom yesterday in the chaos. I believe it is less chaotic yesterday. Tom McKenzie, is at Westminster and picks up the pieces for us this morning. Tom, I want to do Civics 101, which I believe is in the United Kingdom, when you want, you can change the rules. We are going from a count of 20 MPs to get to 5 or 6 candidates, whatever, to 100 MPs to get to 2 or 3 candidates. Who decided that the Conservative Party could change the rules?
So that was the backbench. Well, that was the 1922 committee. Mr. Brady, who chairs that committee, you're absolutely right. Within this system, they do have the power. He does have the power with that committee to change the rules in terms of how they select the leader of the Conservative Party. They've done that, of course, on this radically shortened time frame. As you say, we could have a new prime minister in place by the end of play Monday. The deadline is for the 28th, so Friday, of course, in terms of when they get that new leader. The jostling, of course, and the horse trading continues in the Houses of Parliament behind me. The last count was, according to the BBC, that Rishi Sunak is currently leading with 44 MPs who have come out to support him. But Boris Johnson as well, a lot of reporting that he's cut short a holiday and is coming back as well to throw his hat in the ring. That is not confirmed, is not official. Rishi Sunak, Penny Mordaunt and Boris Johnson, none of them have officially thrown their hats in the ring yet, but they are the 3 leading contenders. The key question is, for the markets, what happens to October the 31st when the new Chancellor, Jeremy Hunt, had said he wants to pronounce and come out with his fiscal plans, which will be checked by the Office of Budget Responsibility. That is crucial for these markets. Now that date is very much in question, Tom.
Tom, how much is it really important for a lot of the members of Parliament that they get a candidate who's going to keep Jeremy Hunt, who's going to keep the status quo, who is not going to pressure the Bank of England to be less aggressive?
Well, Jeremy Hunt has unarguably done something of a decent job in terms of getting the premium on UK assets down after that mini budget. Yields have come off and the pound strengthened. Not in today's market action. There is that volatility back again. Of course, we're seeing yields up and the pound under pressure. But on the back of his ability to unpick that Trussonomics plan and to, of course, gut it, most of it, 90% of it, he did restore something of some stability across these markets. And most of the guests that we'll be speaking to say they would like to see the Chancellor remain in place. Important for investors. Here's the question, though. When Boris Johnson, if he does confirm he's running, we know there is animosity, deep animosity between the current Chancellor Hunt and Boris Johnson. If Boris Johnson takes the #1 spot on Monday, then there is a clear question as to the longevity of the Chancellor, who has done some work to restore, at least partly, the stability across UK assets and, of course, that sense of credibility in the markets.
Tom, how vulnerable is the Tory party right now? How much is Labour making some inroads at a time of incredible deterioration in popularity?
You know, we spoke to a former strategist with Boris Johnson, worked with him on that successful 2019 campaign very closely, has known him for 12 years, and he says it is not hyperbole to talk about the future of this Conservative Party, given just how deep and how entrenched these divisions are. And actually, Rishi Sunak and Boris Johnson are really symbolic of that deep, entrenched division. Rishi Sunak, of course, on one side, the more modest, the more moderate parts of the party. Boris Johnson, of course, who led the Brexit campaign. So you have the right-wing parts of the party, but also have the grassroots who are very much in line with Boris Johnson. Rishi Sunak, though, supported by the moderates, but not so much amongst grassroots members of the party. So a split of the Conservative Party is not out of the question longer term.
Tom, you know, to borrow from the Beatles here from a few years ago, and I guess it's happening right now, according to his father, flew in from NASA BOAC, and so maybe it is Boris Johnson to the rescue. How does he treat now after the scandals with the Labour voters who chose to vote for Prime Minister Johnson a number of years ago? Has he lost them forever?
That is a key question. It's worth reminding viewers, as you've just done, that he did come through with this thumping majority in the election that won over these former Labour seats. But he has also faced all of these scandals. Within the party, 148 members of his own party voted against him in a confidence vote. Outside of Parliament, the popularity of Boris Johnson has declined on the back of all of these scandals. It's also worth noting that he faces a parliamentary investigation as well that would haunt him if he does indeed throw his hat in the ring and if he does end up being the leader once again of this Conservative Party and this country.
Tom McKenzie with our British team here on Bloomberg.com UK. outside of Parliament this morning. Lisa, what we do is we look at the litmus paper, and it's not good this morning. Sterling weakens.
And this, to me, is really telling, given the lack of certainty with the path forward, as well as what it will take, and this goes to what John Micklethwaite was saying yesterday, what it will take to restore credibility to a nation that has seen a pretty significant blow. Let's just put this in a perspective. Whoever comes in next will be the third prime minister of the United Kingdom for this year. It comes at a time when you've seen bond yields surge to the highest levels in more than a decade, and it comes as the Bank of England is tasked with tightening policy at a rate that many people are uncomfortable with, including some of the candidates that have been named to possibly succeed Liz Truss.
And just to pause here, Chris Hayes over at MSNBC had out a tweet yesterday, which was very quietly Prime Minister Truss shaking the hand of Queen Elizabeth II, and all Chris said was, this was 7 weeks ago. Well, that's how fast things have moved.
And that's why it was sort of poetic that she handed in her resignation after 44 days as prime minister to the king after accepting the prime ministership from the Queen. There's sort of upheaval in a nation facing a difficult winter cannot be overstated.
The difficult winter is seen in the bond market and in foreign exchange as well. We're going to continue to follow this story in the United Kingdom, the politics of it. But of course, the ramifications back to the city and to global Wall Street. And I want to go again. I can report this morning, folks, sterling is broken down. We're back to 111.14, nowhere near 107. But any migration of that under a 110 would be shocking and would change this political race.
To be very fair, though, this is a global story, and it comes with dollar strength.
Oh, we
it
see
comes
it this
with
week.
yields higher, dramatically higher in the cases of some denominations in the United States. And to me, that is one of the biggest stories, if not the biggest story of this year.
And how long it takes to have a cup of Tang, it's real simple. The real 10-year yield printing a legit 1.78%. Claudia Sahm soon. This is Bloomberg. Bloomberg Surveillance, we welcome all of you on a Friday, staggering into the weekend, and you need reading. Here's my first read of the weekend. John Byrne Murdoch over at the FT with an absolutely brilliant piece on what he calls the opacity of Chinese data. He's being polite. He's got a couple charts that just are jaw-dropping about how the economic data structure of China is radically different than what it was 5 or 6 years ago. We await GDP sometime before Christmas, I think is what we're looking at. The data, equities weaker, futures negative 21, VIX does nothing, 30.18. Yield is the story. Abramowicz is all fired up, 4.28%. 10-year yield, real yield is stunning, 1.78%, is now 1.61%. Dollar demonstrably stronger today, and sterling with the headlines. I'm going to get a 110 handle on sterling here in a bit. 111.06. That is a much weaker sterling. Yen, a 151 is in its right and own story into Sunday morning as well. Is it always good to have somebody come into the studio who has a relationship, a ratio, an economic belief that's picked up by Fred? This is very, when you have your name in the database of Fred, you're on the edge of rock stardom.
Well, let's bring in the rock star, Tom.
Let's
go for it.
Claudia Sahm with us. So why don't you go to her, Lisa, because I know you're all shaped up here. Out of Michigan with all sorts of discussion and analytics on when a recession is a recession.
Yeah, and what comes is she's been in the Fed. She's worked on the inner workings of this body that has been at the forefront of global economics and markets. Where we are right now with respect to Fed speak, do you think that it is accurate pricing to look at a 5% Fed funds rate for the first half of next year and think that that will be what it takes and that this is going to not torpedo the economy as much as perhaps people are pricing in?
I think at this point, anyone that's talking about the first half of next year, there's a lot of false confidence. I would not be surprised how fragile financial markets are, that the Fed has to pause to get them back under control. Right. I mean, the U.S. financial markets are in a good place right now, but if nothing else, the U.K. has shown us how fragile to an event, to a bad policy decision. So I don't feel confident about what they're going to do in December, let alone where we're going to be by June of next year.
I know what Tom thinks of the parlor game of Fed speak and what they're going to do or what aren't they going to do. It's not very instructive. There is a question about the consistency on the Federal Reserve from a personnel level, and we talk all the time about Fed speak and how much of it there is. The latest, Jim Bullard, the St. Louis Fed president, has been reported to have given a private off-the-record event at Citigroup to hedge funds and bankers. Reporters were not invited. This is causing a firestorm. Even former Fed officials are coming out and saying this does not look good. What's your reaction to this at a time when people are looking to the Fed for leadership?
It's inexcusable. And to me, it's not an optics problem, it's an ethics problem. Jim Bullard is one of the Fed officials that is making decisions about rate hikes that have effects in the United States, will have effects for U.S. workers, and they are having effects around the globe. The idea that he gave any kind of private remarks to investors is outrageous, and he should go.
Ambrose Evans Pritchard did a tour de force in the Telegraph on modern theory and its lack thereof. He tore apart the Phillips curve and the belief in it right now from the early 50s, A.D. Phillips at London School of Economics. He tore apart the Beveridge curve, which Krugman believes in, this out of Beveridge of middle century London School of Economics. Is there a theory right now, or are we making it up as we go?
They're following a theory that is so outdated.
What is the theory they're following?
The Phillips curve. So this trade-off between unemployment and inflation is at the core.
Do you observe that right now?
I can see that in their logic. This is why they're waging a war on workers, trying to get the labor market to quote-unquote soften. They think that's what it takes to get inflation down.
This is your, I interrupt. This is Claudia Samm's wheelhouse, folks. I'm going to make this as clear as I can. If the Phillips curve doesn't work, what is the relationship of monetary theory to our our complex labor dynamics?
So we can use the tools like the Phillips curve, but there is so much supply-driven inflation. The speed at which they are going, the speed at which they need to think they need rates by the next half of the year. That's it. You can't use that tool for that. And there's a lot of research. It turns out we've done research since the 1958, and they're not using it. They're trying to excuse away. It's all demand driven. And if it is, the Fed does that. And the Fed is being very impatient, and it's hard to watch.
If we are ex post, if we are after the fact, what is the data we should look at if we are ex post? Claims isn't getting it done, isn't it? Because jobless claims look extraordinary right now. They look fully employed, frankly.
In a very unusual way, the Fed has painted themselves in a corner and said it is all CPI. The Consumer Price Index is the last place that the lower producer prices, the lower import prices, any kind of weakening, which we're already seeing, that's the last place it shows up. And they've told us they will not stop until it shows up there.
But earlier this year, you were talking about how we could see even disinflation, right? That we could see inflation roll over pretty dramatically heading into year end. We haven't. And services inflation has really been a big driver. It's not just rents. It's much broader. We just get the results from airlines. They're doing great, even though their tickets are incredibly expensive. So what have you gotten wrong with respect to the pace of the deceleration in inflation?
What I've gotten wrong is to look at the macro data. And in talking to businesses now, I mean, they have excess inventories. Why aren't you cutting prices? I mean, inflation is a business decision. They're the ones that write the price tag. And what they say is the consumers are here. Why would we cut back? And so I think the process of some of the supply disruptions, whether it's people coming back to work, whether it's like getting the goods here faster or the strong dollar feeding through, it's taking a lot longer than I would have expected. When I talk to business owners, I'm like, that makes sense.
Well, but this is the concern for the Federal Reserve and possibly the reason why they are being as aggressive as they are, because they had waited too long in the past. And that arguably is the reason why inflation accelerated to the pace that it did. If there is this uncertainty about why it's not coming down more, there is a big risk to not raising rates substantially. Isn't that right?
We're not in the 1970s. There was a decade of high inflation where the Federal Reserve was asleep at the wheel. We've had less than 2 years of high inflation, and the Federal Reserve has gone in big this year. Mortgage markets are showing us, wow, these are big increases and they're really fast. And we know long and variable lags. It takes time. And we also know that the rental market, what's happening right now, those prices are coming down. The Fed knows this. And they're going fast and hard.
Folding the international events here, I was thunderstruck at the IMF meetings how the adults down there have a much longer time frame back 40 or 50 years. And they're much more looking at international dislocations than the parlor game of inflation rate dynamics. At what level is Jerome Powell, central banker to the world, driving the policy of all these different nations?
The Fed is absolutely in the driver's seat. I mean, the dollar has strengthened so much. He is pushing the ECB to raise rates, the Bank of England to raise rates. They have absolutely supply-driven inflation, and frankly, they're going to make a bad situation worse. Europe is headed towards a severe recession, and the Fed they are contributing.
So what do they do? I mean, we've got a Fed meeting November 2nd, and after that, let's have Claudia Sahm, market expert, come in here and give us a take. Are we way overdoing the parlor game out? Fed meeting 2, Fed meeting 3?
They need to slow down. They're not going to. I mean, 75 is absolutely happening. 75, 50, 25 would be great, but I don't know. I wouldn't be surprised at all for a 75-75.
Is currency of value to you here? I mean, to study strong dollar in all the different dynamics of pairs?
So what a strong dollar does is it means it's cheaper for us to import goods. And we like a lot of cheap goods from abroad. And right at this point, we are doing beggar thy neighbor. We are bringing in, with the strong dollar, we are importing disinflation and we are exporting inflation. And that's good for us. Yay, America. But that's not, if we push the global economy into a severe recession, we're not going to withstand that.
You come out of the Michigan Combine, which is massive inflation analysis, all the different professors and the wonderful Granlick and all the rest of it. Which matters to you now, a services pullback or a goods pullback to disinflation or even outright goods deflation? Which of those two is more important?
Well, broadly, we say that the best cure for high inflation is high inflation. Right, that consumers need to get price sensitive. They need to pull back, and we're seeing that there has been slowing in the growth of consumer spending. A rotation away from goods and back to services. It's going to be disruptive. Every rotation we see is disruptive. We need to get back to something that is a semblance of normal.
Lisa emails in and she says, would you ask Claudia Sahm here about what the inflation worriers are getting wrong? I mean, the inflationistas used to be Chuck Plosser in Philadelphia, and now the inflationistas are Larry and Dudley. Line them up like ducks. What do they get wrong right now?
Well, the Larry and Dudleys were right for the wrong reason this year. Last year when they were talking, it was all about the rescue plan. Well, COVID, Delta, and Omicron, and all the variants, and then Putin showed up, right? So if you don't get the story right for the right reason, you will make very bad forecasts. So their forecasts right now are just, set them to the side. The thing the Federal Reserve is doing is they are so afraid of these inflation expectations taking hold. Those expectations look solid. People believe the Fed is into fighting inflation, right? But they're now worried about, they're stable, but they could come unanchored and rise. And it's like, you really are going to tank the global economy over something we have no signs of? And when they move, they move slowly, right? So it's just, that is their big fear right now. It's embedded inflation expectations.
You have cats at home. Your new cat, did you really name it Pivot?
No, she's Puffy.
Puffy, okay. Claudia Sahm, thank you so much with Sahm Consulting, and certainly one of our great experts in this nation of the measurement of a path to recession. We're going to continue. Sterling weakens. That is front and center. Futures negative 20. This is Bloomberg. Stay with us.
Keeping you up to date with news from around the world with The First Word, I'm Kaylee Lyons. President Biden has started aggressively promoting his student debt relief plan. The government has been working out the kinks in the program, and a White House event Monday is set to officially launch an application website. But multiple legal challenges, including a lawsuit from Republican-led states, are moving through courts, threatening to halt the effort. Italy's Giorgia Meloni has clinched a mandate from her coalition on the path to becoming Italy's first female premier. The coalition, which includes her Brothers of Italy party, former Premier Silvio Berlusconi's party, and Matteo Salvini's Lega, told President Sergio Mattarella that she is their candidate. Mattarella is expected to formally ask her as early as Friday to form a government. China has locked down parts of a central city, confining some of its 13 million people to their homes for at least a week. Other major hubs are rolling out virus restrictions as well, reflecting the country's commitment to its COVID-0 policy. Residents in high-risk areas are required to stay at home until no new infections are reported for 7 days, and then they get moved to medium risk. Hong Kong officials have canceled a screening of a Batman film 1 year after passage of a law that lets them ban movies on national security grounds. It was a showing of the 2008 movie The Dark Knight, set for next week at an outdoor venue. A notice said the decision was, quote, based on direction from the Hong Kong Government Office for Film, Newspaper, and Article Administration. Global news 24 hours a day, on air and on Bloomberg Quick Take, powered by more than 2,700 journalists and analysts in more than 120 countries. I'm Kaylee Lines. This is Bloomberg.
I think inflation has reached the top. I think it is starting to come down. I think it may come down more slowly than people are hoping because of the stickiness in the shelter cost and the stickiness in labor markets. But as I said, I think the Fed has had a positive impact.
One of my favorite people, Jonathan Gray of Blackstone Group. If you are young and you make a lot of money, what do you do with it? And this guy, more than anyone I know on the island of Manhattan and the 5 boroughs, is ponying the money to charity. No one like Jonathan Gray. Great to hear from him with Shonali Basak here over what Blackstone's doing, particularly in real estate. Lisa, let's just take a moment here on that. This is a sensitive issue where in the modern age, fancy people with fancy money are cornering the real estate market in America. And that's part of the Blackstone questioning, if you will.
Well, and this has been a story for a number of years. Will they continue to be buyers as mortgage rates go up and prices come down? And also, how much are they going to raise rates at a time? Raise rents. Raise rents at a time when there is this increase, and yet there is popular antipathy toward this.
Futures negative 23. We're watching yields. Lisa stunned by a 1.78% real yield, and that folds into all of our investment calculations on a Friday.
We're seeing a macro move. Let's be very clear.
That's the best phrase of the day.
This is a macro move. Yields higher, dollar stronger, disrupting a lot of different trades. You're seeing that with the euro weakening. But again, this is a dollar story, 97.37 euro dollar cross. You could see this in the 10-year yield breaching the highest levels we've seen going back to 2007. Right. What does this do to reset valuations, to reset understandings, and how much further this has to go? Sebastian Gailey, senior macro strategist at Nordea Asset Management, joining us on a macro move. Sebastian, how durable do you see the moves of today, seeing new highs in yields, seeing new highs in the dollar versus certain asset classes, seeing the yen on the brink of unraveling?
Yeah, the interesting question is, in essence, can we predict how high the Fed has had to go when we don't understand the inflation dynamics very well? Over time, people have become more detailed, supply, demand side, looking at rents, looking at the different subcomponents, analyzing the different stratifications within the consumers. Are rich consumers, they don't care. There are middle income consumers, some of them do care, they're very leveraged. And the ones who are poor, obviously, you can't sell so much to target. Others have to basically are left with inventory of prices which they've overpriced. The margins are very, very, very high profit margins. And so we have this big demand which is coming in with supply, which is an issue, and eventually it slows down, led by the poor, but the middle income and the rich are still doing very well, and the message hasn't completely gone through that leverage is getting very expensive, that your real estate market is probably overly expensive. And so there's not yet the moment of doubt within U.S. consumer where everything adjusts. And on the corporate side, also, some of the corporates remain in a delusion. They think everything is actually doing well. From CEO confidence indeed has fallen a lot, but it's probably led by the people who sell low profit margin type of products. The likes of Apple are a little bit worried they might fire 1,000 people, not very much more. And so we haven't seen that big adjustment both on the household side, on the corporate side. And when it happens brutally. And that's the issue. We don't know when it's going to happen. We don't know how much the Fed exactly has to tighten. It's probably already over tightening, but it has no choice.
How close are we, Sebastian, to something breaking in markets before they reach that point?
And if you look at equities broadly outside of the United States, they're actually quite cheap. So if you have to make a call as an asset allocator, you can say in the next 3 to 6 months, or let's say 3 to 5 months, is actually going to become very interesting for equity investors. From the U.S. Side, some of the stocks, NASDAQ and the likes, still remain very expensive. There's still this belief in America being a great economy, well-managed economy, and being just a great place to invest. And it's not only for Americans, but pretty much everyone else around the world. And it's part of the reason why the dollar is so strong.
Yeah. Sebastian, you wrote a brilliant essay of optimism on the United Kingdom. You said the compare and contrast with Italy is wrong. Explain to us your optimism as the United Kingdom extracts itself from political crisis.
And so one of the reasons you can get political instability is because you pander to simply one group within that population and not the entire population. And UK has a long history of basically being well governed, and we've seen significant accidents recently. But in general, they just know how to do the right thing, both from the Labour side and from the Conservative side, not always immediately, but eventually. And so there's a sense that there's a social contract in the United Kingdom, as you can see it also all around Europe, not everywhere around Europe, and also to some extent in the United States. And it means that people believe that the Bank of England will eventually do the necessary. The government eventually does it. And Mrs. Truss actually resigned. Nobody pressured her. She was under significant pressure, but she did it by herself. So she considered, okay, this is not good for the country. I will step aside. It doesn't happen in many countries.
I got a day trade through to Monday. Am I going to go long sterling here, Sebastian? Help me.
What you want to do in FX in general, preferably, is avoid it. I have long experience as a currency strategist. What you do want is stay on a long dollar position, but it's becoming increasingly dangerous both on the dollar yen side and dollar versus emerging market. We're seeing the renminbi weaken consistently on the back of what must be recession in China, and so it's a difficult and unfortunately complex environment. The long dollar story probably still has some legs, but it's becoming very dangerous.
Sebastian, thank you so much. Terrific Friday brief. Sebastian Galli, always better on Friday when Nordea Asset Management is, well, Lisa, I use this word too much, but the swirl that we've been through, not only this week, but the month, or maybe it's 8 weeks. I lose track here in this forever long 2022. I look at the screen and all I can hang on is the inflation adjusted yield. That's what every guest is focused on.
And to be very clear, because people will say real yields are still very negative. They're not actually positive if you look at where inflation is now. This is for what people are gaming out in markets for inflation over the next 10 years. So that means that people think that the Federal Reserve is going to raise rates by the most above where that inflation rate is expected to be over the next 10 years, going back to 2009. How much, though, does this talk about what we've been discussing for a long time? People keep getting it wrong with inflation, and we don't understand why. The lack of certainty around what the main drivers are and the stickiness of this. I mean, Philadelphia Fed President Patrick Harker yesterday.
What did he say?
He said that the Fed's anti-inflation policies are, quote, frankly disappointing. And he talked about how he expects the yields to be, Fed funds rates to be well over 4% by year end. This is the base case.
Yeah, but to me, it's not the level of what the yield is doing. It's going to be the length of that. And the major message I have out of IMF meetings and all that's going on right now is transitory is just gone. There's no other way to put it. And we're getting comfortable with yields from 30 and 40 and 50 years ago, which leads me into my great theme, I think, for next year, which is the great zombie roll-up. What do you do? What do you do in tech if you're a non-profitable company? How do you drive that forward?
You're seeing it certainly in the share prices. Did you see Snap? I mean, it lost a quarter of its value
Snap and
after.
TikTok, and look what they did.
Well, yeah, exactly. It's all because of you, Tom. It's if only you would endorse that. All of these companies that you're seeing that really blew up during the pandemic and expanded have been deflating bubbles over the past couple of months and just continue to be so.
113 DXY, the yen, a 151.34 is newsmaking through your weekend to the Asian Sunday morning. Stay with us. This is Bloomberg.
We're probably probably going to see persistent inflation and that these yields are not overdone.
The real worry is not only about this winter shortages, but also next winter shortages.
We have an almost abnormal obsession with all things inflation.
For the most part, what we're seeing is the consumer's okay.
People continue to have a pretty high cash coffer.
This is Bloomberg Surveillance with Tom Keene, Jonathan Ferro, and Lisa Abramowicz.
Good morning, everyone. Jonathan Ferro, Lisa Abramowicz, and Tom Keene on a Friday on radio, on television. What you need to know. Well, we're going to go to Tom McKenzie at Parliament on the Derby in the United Kingdom. It is an odd Friday in the United Kingdom after the history that we saw yesterday. We are going to try to steer through the next 2 hours. Steve Major to join us with HSBC here on yields. Lisa, it has been secondary this week. It deserves, as you say, to be the macro story. A 10-year real yield can't get out of its way, 1.78%.
Bond markets are taking charge in a global economy and the global political regime that I could arguably say, given what happened in the UK. How much does this really tie the hands of fiscal policymakers that have gotten used to central bankers that will buy their bonds and bond markets that will give them cheap financing at a time where yields are surging to the highest levels in more than a decade.
And surging is the right word. I mean, as we go into the jobs report, as we go into November 2nd, and a Fed meeting, the answer is there's a dynamic here into that meeting we didn't see 2-3 weeks ago.
And part of this is driven by that tension that we were parsing out with Claudia Sahm, this idea of the Fed is moving further than people had imagined they ever would or could, simply because we have been surprised again and again with the inflationary impulse and how durable it is and how strong it is. And it's not just the U.S., it's Canada, it's the United Kingdom, it's the European region.
You know, I look here at the Bloomberg Index, and this is the blend, folks, that you see on the Bloomberg Total Return Index. There's like 8 or 9, 10 of them, and there's one that you center on. Negative 18% in widening out every day, a price decline in bonds.
And a price decline that people are saying is resetting yields to a level where they're sort of becoming attractive, but the marginal buyer is not yet coming in. And I know that you have your thoughts on that. But how much is this a reset, to your point about how long rates remain at this level? A reset in corporate America, in the global corporate sphere, with roll-ups, with potentially companies going bankrupt.
Yeah.
Right now, we're not seeing that price into the market. And earnings have held in, at least for the most part.
Sunday night, Phillies, Padres, maybe. Yankees, Astros, maybe. Ministry of Finance, maybe.
Exactly.
We may get in our Sunday night at 151 on yen. Maybe we need to pay attention.
I know, right? 151 climbing in terms of the dollar versus the yen. And at what point do they step in? What's the line in the sand, right? People were saying it was 150. It surged through that. They before said it was 145. We're well past that. And how much do we keep going? And are they just simply going to try to control the pace of the deterioration, of the weakening in the yen versus the dollar versus outright support it?
On Friday, not that many earnings on Friday. American Express comes in with a report. We'll go over it in 2 seconds here. Revenue up 23%. It was supposed to be up 25%. I mean, that's what their view is. Those seem like ginormous numbers. And yet it trades off a little bit here. They see their forward guidance is not so forward.
The full year earnings per share is estimated to be $9.25 to $9.65. The estimate was $9.90. This is actually really quite important, given this could be a bellwether on wealthier individual spending, and whether they could be cutting back as well. I don't know. We haven't seen it in the
The acclaimed Bloomberg headlines on American Express. Here's one. American Express haven't seen changes in consumer spending. And the next headline is Redo, keeper of the Amex, says Tom stopped spending. So there's some of the granularity that you've got. Data. Let's do it right now before the brief. Futures negative 17, Dow futures negative 100. The VIX critically above 30. The VIX has gone nowhere this week. That in itself is a story. The curve inversion a little bit less, and that 10-year real yield 1.77% on dollar strength. Lisa?
Yeah, we are looking also at a slew of Fed speak, and I really do have to harp on this Patrick Harker comment yesterday about how it was disappointing how the Fed tightening has worked so far and where the CPI has come in. We do hear from John Williams. New York Fed President 9:10. Charlie Evans is expected to speak, Chicago Fed President at 9:40 a.m. Also today, earnings. We did just touch on American Express, which just came out in about a half an hour. We'll get Verizon Communications. It's been hit or miss, right? It has not been consistent. We have about a quarter of the earnings coming in at this point, and it's really been hit or miss. American Express missing to me is very interesting. I'm curious to parse through and understand, okay, if their spending habits aren't changing, why is revenue coming in light?
What I don't get here, Verizon, 10-year total return per year, 2.83%. I don't know what to do with that.
Well, but this was what we were talking about yesterday. Utilities have been chugging in at less than junk bonds in terms of the returns. Does that change? I mean, how many people have come on this show and said utilities are the place to be because they're havens, they haven't been bid up, they haven't done the snap thing. All right, we're also going to be hearing from European leaders today, and this to me is something I am just sort of keeping an eye on. This is the second day of a summit in Brussels, talking about price caps, talking about what to do with the energy crisis. I know.
What's important about this? Seriously, explain for our American audience, what's the so what of Brussels this morning?
Two things. Number one, I want to see what they have to say about Liz Truss's resignation and where the bond markets have been pricing different plans to try to address the energy crisis. And then I want to understand, okay, crisis over, we see natural gas prices in Europe plunging on the likelihood that they have higher stores. So what do they have planned for the winter after? How about the winter after that?
Okay, Tom McKenzie here in a bit will give us an update from Parliament. Right now, your conversation of the day of a diversified portfolio. Sarah Hunt joins us, portfolio manager at Alpine Saxon Woods. We'd love to have her on with the linkage here of all the media babble into what do you actually do in the equity market. Sarah, how much cash do you hold right now?
I would say that we're holding higher than normal cash levels. So if normal is somewhere between 0 and 5, maybe you're closer to 5 to 10, or in some cases over that. I think that this is a very difficult time in the equity markets. As we've seen, the volatility has just been much wider than expected. And we have had the markets come down and multiple compression before we really get an earnings reset. And I think that's the biggest issue going forward, besides what the Fed is doing. It's the earnings reset. And we haven't really seen that yet. And I think it's coming.
And given that you think it's coming and other people do too, I wonder how much Chris Harvey really was ahead of the curve yesterday when he was saying that he downgraded banks to neutral from overweight, even after they just reported better than expected earnings, because it offered a pop in the market that gave him a good exit point. How much are you looking at earnings to basically cash in or out of the sectors that you don't like on some sort of strategic level, regardless of what the earnings actually said?
Well, I think what we're looking for on the earnings side is more consistency than trying to cash in or cash out. I mean, I think the banks have a tough road ahead of them, just given the fact that you still have an inverted yield curve. And so I think that as much as they've had good numbers so far, I think that that is why people are a little bit concerned about them going forward. I think that the hard thing is you just look at every different piece of this market and you're getting some good news and some bad news. Like UNP said that they're worried about stuff. CSX said they weren't as worried about going forward carloads. So I think that there's just a lot of uncertainty between companies and everybody else right now. And I think that I just don't see how S&P, which consensus has higher next year, I don't see how that doesn't have to change before we start to get more comfortable with where equity valuations are, because the multiple compression has happened, but the E is still expected to be higher next year than it is this year.
Let's just put a bow on that, Sarah. Does this earnings season so far make you more or less bullish on riskier assets in the months to come?
I don't think it does either. I think really, I mean, this goes back to what are you looking for? We're looking for companies that can both grow their dividends and have some consistent earnings power, that through different cycles. I mean, I think that this earnings season isn't really changing that. The fact that Adidas just came in after Nike with bad numbers and everyone's saying the consumer is so great, I think there's just a huge disparity in what's going on in different places where people are spending. And I think it's really hard to game that out ahead of time and think that you know exactly where you're going to be correct.
Sarah, it's a new territory in that we're going to some form of risk-free rate. A lot of really good conversation on this show about the new regime for equities. What does the Sarah Hunt new regime look like if you get an actual real yield, an actual risk-free rate?
Well, you guys have talked a lot about on this show about the fact that it's hard to price risky assets when you're still repricing the risk-free rate, right? So that's part of what some of the volatility is about right now. I think historically speaking, it's not unusual to have rates maybe not in the 5 to 6% range, but maybe in the 3 to 4% range. And I think that there will be an adjustment to that. And part of that adjustment has been the multiple compression that we've seen so far. The problem on top of that is that we're probably facing a recession if we're not already in one now. And we certainly are concerned about global growth, and not just U.S. growth, but growth everywhere. And I think that part of that, you've got energy prices that are problematic. You've got food prices that are problematic. Right. Some of that on the back of Russia, Ukraine. There's a lot going on.
So I just need some advice. Do I buy Apple this morning?
We like Apple. I think that the market gives you opportunities to pick everything up a little bit cheaper, and this is what we've seen so far. So there's a lot of stocks that we like. I think of Apple as more of a staple than a tech company because nobody can live without their phones or their iPads. No. I think that there are some places in the tech world that we like. Right. Still, the whole group is being sold together for the most part, although Apple has held in better than a lot of its compatriots.
There's your banner this morning. Hunt, Apple is a staple. Sarah Hunt, thank you so much. Alpine Saxon Woods as well. Let's digress to tech chat right now. Yeah. At your house, do various offspring have lined up the next Apple item that needs to be bought?
No, in my household,
I think I'm like 4 out.
Seriously, they have antiquated tech that they sort of line up and have multiple screens in front of their.
Come with a vengeance.
Yeah, no, but it's funny. They have like 5 screens and they kind of switch from screen to screen. I'm basically a fantastic mother, as you can tell.
I can tell.
But
it's abuse.
Basically,
it's amazing. This is really important actually with all the the macro babble we do. Some of these stocks are staples like toothpaste.
Yeah, although you possibly aren't buying as many upgrades if the kids can actually go outside and play with their friends rather than during the pandemic where they couldn't. I'm just saying that, now there is an alternative and you can kind of say, guys, get off the screens.
Go out and play.
They can say, no, we don't want to.
Remember that?
You can try really hard. And
anyway,
I'm digressing.
Dollar strong, you're just going down in flames. Steve Major in the next hour. Stay with us. Dollar stronger. Good morning.
Keeping you up to date with news from around the world with the first word, I'm Kriti Gupta. Ukraine's foreign minister says he talked with Israel's prime minister about Kiev's request for defense systems to help combat Russian missiles and Iranian-made drones. Israel has offered to assist Ukraine with a missile warning system, but says it will not provide weapons. The U.S. has accused Tehran of sending trainers and technicians to Crimea to support Russian drone attacks. And the European Union has agreed to press ahead with a set of emergency actions to address the bloc's energy crisis. It comes after Germany yielded to pressure from other member states to pave the way for a temporary price cap on natural gas. The European Council's president says the move sends a clear signal to the market that the bloc is ready to act together. The Biden administration's officials are said to be discussing whether the U.S. should subject some of Elon Musk's ventures to national security reviews. Sources say that would include the Twitter deal and SpaceX's Starlink network. U.S. officials are uncomfortable with what they see as Musk's increasingly Russia-friendly stance and his plans to buy Twitter with foreign investors. Credit Suisse will aim to settle a tax fraud and money laundering case in France on Monday. The Swiss lender is reportedly in the final stretch of negotiations with prosecutors to reach an agreement that would include a fine but no admission of guilt. The size of the settlement is unknown, and the deal could still fall apart ahead of the court hearing. Global news 24 hours a day on air and on Bloomberg Quick Take, powered by more than 2,700 journalists and analysts in more than 120 countries. I'm Kriti Gupta. This is Bloomberg.
We fixed a high threshold, but a threshold that should be achievable by any serious candidate who has a realistic prospect of going through. A threshold of 100 members of Parliament nominating a candidate obviously allows for 3 candidates potentially to come forward.
Graham Beatty for the Conservative Party. The minister, Brady, is the one making the rules. Maybe he's like the head referee at the NFL games this weekend. We welcome all of you on radio and television to a most interesting Friday. John Farrow's off. Lisa and I are really trying to focus on bonds, on stronger dollar, on yen weaker, rounded up, a 152 yen is stunning. But yes, even we on this Friday must turn to the United Kingdom. And we do so. The movable feast now's BBC just has the esteemed Defense Secretary, Ben Wallace. He will not run. And I think the major message for Americans on this Friday is, don't we wish in America we had the timeline of this race? Wouldn't it be great to have a midterm election or presidential cycle that goes to 9 a.m. on Monday?
It is 9 a.m. Monday. We're going to find out
our time,
what happens in terms of leadership. I don't think that anyone in the UK would say they're in an enviable position right now in terms of some of the tumult. We do, of course, though, think that we have an enviable position in terms of our bench of people who have been covering this. Tom McKenzie right now at Westminster of our Bloomberg here. And I'm wondering, Tom, you're watching all of the MPs come out with flags saying who that they're going to vote for. Who's the front runner right now?
Well, the front runner remains Rishi Sunak, of course, the former Chancellor, but also the person who triggered, of course, that pushback that eventually led to Boris Johnson being forced out. And that has alienated him amongst large swathes of this Conservative Party. So we're looking at the Daily Telegraph, that is the Conservative leading newspaper. They're quite well sourced. They've come out with around 48 MPs now backing Sunak, 37, though, for Boris Johnson and 16 for Penny Mordaunt. Worth reminding viewers, none of these three candidates have officially confirmed that they are, in fact, running. But that's where we are in this. We are monitoring the number of MPs coming out, putting their names behind these candidates. And as you said, we could have a new Prime Minister, a new leader of the Tory party and a new Prime Minister of the United Kingdom as soon as the end of play Monday. The first ballot, as you said, 9 a.m. US time, 2 p.m. UK time. The official deadline, they have to have chosen someone by Friday the 28th.
It feels like there's somewhat of an existential question behind this. How much authority the new Prime Minister will have coming in, given the diminished influence of the Tory party, given the black mark of Liz Truss. What's your view on that?
Well, these are politicians now with policies that are being policed by the markets, and that has just been made ever clearer. You're seeing the volatility again with the pound under pressure today and yields up. They now know, even the orthodox or unorthodox members of this Conservative Party now know that their policies will be closely scrutinised by the markets. And so to that extent, there are the guardrails around the policy making. But then there are the polls that they have to contend with as well that show an historic lead for the opposition Labour Party. Yes, we are officially 2 years out from an election, but to what extent can you push through policy when you are divided in your domestic party and you're facing the kind of pressure from voters when it comes to the polls as you look ahead to those potential elections?
Tom, the Sunak-Johnson animosity, is it a personal thing? Is it, heaven forbid, actual political theory they disagree on? Color this, not hatred, that's too strong a word, but color the political reality these two face.
So I was speaking to the former strategist for Boris Johnson earlier this morning. He said this is a personal dispute. They dislike each other personally. There was the tension leading up to, of course, the ousting of Boris Johnson. In terms of the policy agenda and the framework, well, this former strategist for Boris Johnson said he doesn't really have an ideology. Rishi Sunak does. He's been proven right around the market reaction to this mini-budget, unfunded tax cuts. So in that respect, he has credibility with the market, and he has support with at least some factions of the Conservative Party. But he is also, the former Chancellor, deeply alienated those parts of the party, those members of Parliament, but also grassroots supporters of the Conservative Party who continue to support Boris Johnson. So the idea that these two would serve together is very unlikely at this point. The other question is, if Boris Johnson does win this, what happens to the current Chancellor, who has done and made some progress in restoring some of that credibility?
That's right where I wanted to go. Just to wrap up here, Tom, and my head is spinning on this, folks.
Yeah.
Johnson, who's his chancellor? Sunak, who's his chancellor? What's the game on that right now?
Boris Johnson and his chancellor, frankly, very, very difficult to say. You can say that he's going to rule out Rishi Sunak. Absolutely.
Yeah, okay.
Does he stick with Jeremy Hunt? Possibly. There is some animosity on that front. Rishi Sunak wins this. He's currently leading with more MPs backing him. A long way to go, of course, until that Monday ballot. Who does he choose to be his chancellor? Possibly someone from the right of the party to try and close that division.
My deepest sympathies. Tom McKenzie, thank you so much with coverage in this absolute chaos in the United Kingdom. And Lisa, seriously, to their great credit, after the whatever it was 7 weeks ago, 6 weeks ago, whatever it was, the madness, the timeline here is just shockingly short. A week from today, they're going to have a prime minister. I think Monday, 2 p.m. their time, we're going to get a real clarity on that. And I don't know what happens between Monday and Friday.
What Tom said there was really prescient, I think, also. The markets are in control here, that basically any conservative member who comes into the office is going to have to run their policies by the market, essentially, to see whether there is enough stability in the response, whether bond yields don't climb dramatically, whether you don't have a further sell-off in the pound before they are ratified by the public. This really calls into focus this question about how tenuous right now the political system is at a time when there is historically low popularity for the Tory party.
No, but to sum this, the vigilantes are tangible. I mean, there's the bond vigilantes, there's the FX vigilantes, and there's the Bank of England vigilantes. I mean, I don't even understand where Governor Bailey fits into this.
Well, there's going to be increasing pressure, and there has been already, to possibly pull back with some of the rate hikes, saying, look, we've got your back with the fiscal policy. We're not going to be spending a ton of money. So at what point does that become a problem for markets as well, right? You don't have a candidate who can actually call into question.
Bring that over to the Fed. I'm going to bring up the FOMC screen on the Bloomberg November 2, December 14, and I click the little thingy here, and I go out to a long ways away from December 14th, February 1, and on to March 22. Where are we March 22nd of next year?
Well,
I have no clue.
The market's saying 5%, and it's saying that we're going to stay there for quite a while. And that, to me, is sort of a sea change, given where we had been.
Massive. What does that do to dollar?
I mean, that's what you're seeing. Well, you're seeing it do to dollar, right? I mean, you're seeing it strengthen against absolutely everything, and torpedo right now, the end.
The team coming off of yesterday's festivities and fireworks in the United Kingdom. A great lineup today. Leslie Falconio will join us. Stephen Major of HSBC in the 8 o'clock hours. Stay with us on this Friday. Good morning. Bloomberg surveillance movers coming up. One of the movers is the government of the United Kingdom. Lisa will have that for you
Tom.
In a moment. John Ferro is off. We've had hundreds of emails today. What's the likelihood of a Ferro sighting Monday? And I'm really not sure.
It depends on whether there's a sighting of a new prime minister.
I think it is. It's hinged on the new prime minister as well. John Ferro will be with us, I believe, back on
He'll
Monday.
be back, yes.
And I talked to him yesterday at length, actually, and he was following the festivities in his disunited kingdom. Thanks to Tom McKenzie at Parliament this morning. We'll have much more reporting on this. This is a movable feast, folks, for the morning. Stay with Bloomberg Radio and Bloomberg Television. Ben Wallace, the Secretary of Defense, I'm using that as an American phrase, in the United Kingdom has just ruled himself out from running. Futures negative 13, Dow futures negative 104, VIX 30, but actually a little more constructive. Oil doesn't give me much love this morning. Currency, stronger dollar. Yen is the story. Watch it through the weekend to their morning, a 151, 152 on yen. Sterling took a run to 110, weaker, 111.27. Market movers. Lisa.
Thanks, Tom, for that. I've been looking at the big tech names, which we were talking about earlier.
Next week,
and
right?
We get the big tech on Thursday, the sort of Amazon behemoths and the Apple. But we got Snap, and Snapchat's been on a downward trend pretty significantly, and it is down by more than 25%, now down more than 27% after reporting its slowest quarterly sales growth ever. They missed their estimates. How much does this really speak to a problem in the broader ad-driven tech world? And this is the reason why you're seeing some of the other names sell off in sympathy. Meta, among them, down almost 3.6%. Google, or Alphabet, the parent company, down 1.7%. Again, this speaks to why advertise if you, A, don't have the goods to sell, which actually isn't the case anymore if we talk about inventories, but B, if you really don't see the same kind of revenues and your margins are getting cramped, and you need to really right-size and figure out the business plan ahead. Talking about right-sizing Twitter, there were reports overnight that if Elon Musk comes out and does buy this company, he plans to cut the staff by 75%. Those shares down by 7%, not because of that, but because this morning, Bloomberg is reporting that U.S. officials are questioning the deal and investigating some of the ins and outs of Elon Musk and what he's done.
I read this wonderful reporting from Bloomberg, from Jennifer and the team at Bloomberg. And first of all, this is really serious, really original.
Agreed.
Here's a guy who gave technology to Ukraine. Great. And I don't know the details of that, and I don't have an opinion on that. But this transaction may be held up because that's like a Department of Defense national security thing.
But it highlights Elon Musk as a polarizing figure and someone who really skirts the edges of compliance, the edges of what's okay, including on Twitter. And so how much does this really affect the likelihood of him taking over? And then what does that say about all the job cuts? Because even before he was planning to take over, they had planned cuts for that staff.
Right now, Verizon out. It looks okay. They're going to, quote, start cost savings plan.
Yeah, read job cuts.
Yeah, thank you.
I mean, that's basically it. Oh, can I just say one other thing? You know, when I was confessing...
Can she say one other thing? Okay, go.
Okay, thanks. When I was confessing my terrible parenting, someone, a viewer who begged me not to be named, said, in our house, we have had to use going outside and playing with your friends as a punishment for not doing your chores. You are not alone. I love that. That really, I think I should use that.
These kids today.
These kids today.
What can we say? What we can say is to speak to Leslie Falconio, head of U.S. Fixed Income Asset Allocation at UBS Wealth Management. Leslie, thank you so much for joining us. And so much of this is the readjustment to the news flow we're seeing. Are you into a year ahead review yet, or are you still trying to get through the fourth quarter?
Well, we're in a little bit of both. You know, I think that we're trying to understand the fourth quarter to really project the year ahead. And I think that one of the interesting things as we look at what's happening in terms of this fourth quarter and how we enter 2023 is that we're seeing these yields in the 10-year that we haven't seen since, 2007. You have a large correction, particularly in fixed income, and mostly due to the rise in interest rates, will really set the tone for next year.
They're going to set the tone for next year, and it's a yield structure back from another time in place. Does that change your equity allocation or the factors that matter in equity that you finally have a risk-free yield?
Well, I think, as a fixed income person, I look, very closely at the risk-free yield and what you're being offered in terms of equity versus fixed income and how much that risk-free rate has risen and whether it's high yield or equity, investors are compensated by that risk premium, given that we have seen this rise in interest rates. And overall, in our opinion, I think the fixed income market is a bit ahead of the equity market, particularly the U.S. equity market. And in those pockets of vulnerability that we're seeing that really haven't adjusted in terms of risk premium, when we think of sectors such as high yield. High yield has been incredibly resilient this year. At the spreads of 490 or 500, you're maybe at the median spread. So, we don't think that going forward, what investors need to look at is really where the underperformance has come from, mostly has been a rise in yield, and whether or not you're really being compensated in terms of your risk premium.
Brilliant. And Lisa, this is to the heart of what you've been talking about, with some parts of credit have moved and other parts have shocked by the lack of movement.
Especially in the riskier segments, the more leveraged companies that are hanging in there because they are less rate sensitive. So let's move that into some sort of investment thesis. I mean, one of the biggest consensus trades that I've heard of recently is investment grade bonds. So many people love investment grade bonds because they have sold off dramatically, yields at the highest levels going back to 2009, and yet yields keep rising. What gives?
Well, I think, the yields keep rising because interest rates keep rising.
But spreads too.
Spreads as well, yes. And I think the difference between, say, like high yield and investment grade corporates, and by the way, we think high yield is very rich to investment grade right now, both fundamentally are at a situation where they have very low leverage, high interest coverage. But as the Fed raises rates and you have this borrowing cost that's going to stay higher for a long period of time, particularly during a period next year when growth will be slowing, you really have to assess which sector you want to be in and where you're being compensated for that potential pocket of vulnerability. And we do think that IG, given the fact that it's widened out a bit because it's seen much more supply, offers much more value than high yield here.
So right now, are you basically really going into longer term treasuries and some of the higher quality investment grade names and just locking it in and saying, if we can get 6% yields, which is what you're getting on average in the investment grade space, well, hallelujah, let's hang on here for the next 3 years and we're going to look great?
Well, I think what you just said is very important the next 3 years. And I think you have to look at, value versus timing. And look, as we know, this is not the most liquid market, and there's a tremendous amount of volatility. And we are getting incrementally longer, meaning we're adding a bit of interest rate risk incrementally, but we are in the fourth quarter. We do believe 6 months from now, yields will be coming down, and that, the opportunities we're seeing today, particularly on the yield and rate side, will actually be a tailwind to performance next year. But in the short term, you're going to have some volatility. But the yields that we're seeing here in both, whether it's investment grade corporates or agency mortgage-backed securities, and the spreads, we haven't seen them, in probably about 10 years.
We're just talking about the U.S. here. What about the United Kingdom? Are you buying that dip?
Well, I mean, the UK is a little bit, in our opinion, I think a little bit too volatile. I mean, I think there's a lot still happening in terms of the UK, in terms of a falling knife that you might not want to step in front of. There's a lot of issues that may have been resolved, but we do think they're going to be a bit more of contagion in terms of the potential recession in Europe, and the volatility there is a bit too high.
Well, see, I want to back up and just look at the carnage that's out there for many clients, and not just UBS Global Wealth Management. It's been a group effort to see price down and yield up. How do your clients who have a 10%, 15, dare I say, 18% loss in fixed income, how do they respond to the idea of reallocation and making a new go of it?
Well, I mean, look, there's no question. I mean, the performance in fixed income, the double-digit negative total returns has been very visibly displeasing. But, the purpose of fixed income is income. And you finally have a wider opportunity set that we haven't seen in years to compound that income going forward. I mean, particularly if you're an investor that holds to maturity, you're getting prices that are well at a discount. You'll move up to that par level and earn that incremental total return. And it's still an important part of a portfolio, particularly as a diversifier. And again, I mean, when we think about the magnitude of rates that we've seen in 2022, we don't expect to see the same magnitude in 2023.
Leslie Falcone, thank you so much with UBS this morning. Lisa, I want to go to your wheelhouse here, and it's on this idea that high yield maybe hasn't deteriorated like the others. And folks, you can see these in fabulous indices at Bloomberg. This is, of course, all the legacy of Lehman and Barclay. Now with Bloomberg, our total return indices are really informative, particularly when you look across a set of them. And the high yield one hasn't moved like the other ones. So when I say to you, Lisa, the zombie roll-up, which is easy in equities, what does a zombie roll-up look like in distressed debt?
It's unclear because, and this is actually a debate I've been going back and forth with a number of different investors, why has high yield remained so intact given the pain that we've seen in investment grade debt? And there's an argument, well, it's less rate sensitive, but it's also on the spread side. And then people say, well, they're better capitalized, they're better rated, and they have longer maturities. And oh yeah, the oil sector is doing great, and the energy sector is a significant portion of it. So that's the other argument. But then you have all the people who flood in, just like Leslie Falconio just said, and said they're just getting it wrong, right? And so then that leads to the question of, well, then what does this credit cycle look like if you don't have a Fed that's going to come to the rescue? And if you do see yields, baseline rates go to 5%, and this is your point, Tom, and this is a good point, and stay there for a longer period of time.
I mean, I just brought up, you can do this, folks, on the Bloomberg. I'm like the worst person in the building on this, but I'm enjoying the Snap 5-year, 4-year out, 6 years out convertible bond. And I'm enjoying that, Lisa, from 100 down to 69. It's down 30%.
Yeah, I mean, it's been dramatic, but...
I mean, people don't talk enough about the price decline in some of these single bond securities.
Although you could argue, even with that huge price decline, we haven't seen the forced selling. So you haven't seen the really dramatic dislocations that would either cause the Fed to come in or would cause people to be able to buy truly on a discount fire sale. So... is this really as bad as it gets, right? And this is what some people are saying.
No. As bad as it gets is the 98-year Austrian bond Ferro got me into. We'll look at that in a moment. This is Bloomberg. Stay with us.
Keeping you up to date with news from around the world with the First Word, I'm Kriti Gupta. President Biden has started aggressively promoting his student debt relief plan. The government has been working out kinks in the program. A White House event Monday is set to officially launch an application website. Meanwhile, multiple legal challenges, including a lawsuit from Republican-led states, are moving through courts threatening to halt the effort. Italy's Giorgia Meloni has clinched a mandate from her coalition on the path to becoming Italy's first female premier. The coalition, which includes her Brothers of Italy party, former Premier Silvio Berlusconi's party, and Matteo Salvini's League, told President Sergio Mattarella that she is their candidate. Mattarella is expected to formally ask her as early as Friday to try to form a government. China has locked down parts of a central city, confining some of its 13 million people to their homes for at least a week. Other major hubs are rolling out virus restrictions as well, reflecting the country's commitment to its COVID-0 policy. Residents in high-risk areas are required to stay at home until no new infections are reported for 7 days, and they get moved to medium risk. Hong Kong officials have canceled a screening of a Batman film 1 year after passage of a law that lets them ban movies on national security grounds. It was a showing of the 2008 movie The Dark Knight, set for next week at an outdoor venue. A notice said the decision was, quote, based on a direction from the Hong Kong Government Office for Film, Newspaper, and Article Administration. Global news 24 hours a day on air and on Bloomberg Quick Take, powered by more than 2,700 journalists and analysts in more than 120 countries worldwide. I'm Kriti Gupta. This is Bloomberg.
What you saw Trust do, very much linked to what Quartain did, was to essentially try and blow up the markets. I mean, there was no possible way of having these enormous unfunded policies. The markets simply couldn't sustain them.
The professor from Dartmouth, David Blanchflower, was with us not once but twice yesterday, and we really thank him for his perspective here on his Bank of England and, of course, on the political uncertainties in London. Right now, 4 or 5 movable feasts, and we had to look at 2 or 3 and push them aside by a single headline from the White House. This is according to Bloomberg News. White House not aware of national security review for Musk Ventures. And Lisa, this has to be Twitter, and I guess we'll have more on that coming up here.
Yeah, and we are seeing the shares pull back from some of their earlier declines, down only 3.5%. I will just note this, that our own Jennifer Jacobs had tweeted the story out, and somebody responded, it would be hysterical if the government stopped Elon from overpaying for Twitter. And then Elon Musk responded to that saying 100% with a laughing, crying emoji. So that was, his technical response to that.
My distant view is price to sales. It's ugly. Also is sterling. It was a weaker sterling through the tumult of the morning. It has rebounded in the last 1 hour, and suddenly, as Calum Pickering was wired up, Lisa, sterling's rolling over. We're not through a 111 yet. We'll have a headline on that when we see it.
Meanwhile, the earnings very much bleeding into the forward economic view. American Express just recently coming out missing and saying that they built more for charge-offs, more provisions, and they increased their expected charge-off rate going forward. Calum Pickering joining us, senior economist at Bloomberg. Given how quickly things are moving, how much are markets getting ahead of themselves with respect to how high rates this market can handle, this economy can handle, and how pervasive this inflationary push really is?
That's a good question. I am actually wondering at the moment whether the bond market and the equity market are worried about different risks, and these risks are mutually exclusive. So the equity market is now starting to panic about the squeeze in earnings and the loss of pricing power and weaker demand. The bond market still seems to be telling us that we've got more inflation and interest rate risk to worry about. Those are mutually exclusive events. If we get the loss of pricing power, then we don't have to worry about inflation into next year. And so I think it's more likely that the equity market is actually calling this right than the bond market, in which case we should be anticipating when central banks pivot quite soon.
All right. So this comes at a time when the bond vigilantes are back in force. And from London there at Berenberg, you have a good view into that and just how violent that response can be. Yep. Can the central banks afford to pivot given how jumpy bond markets are, whether or not they're right?
Yep. I think that's a really interesting way to look at this, because it probably means central banks cognizant of this and don't want to go through the UK experience where all of a sudden bond markets really start to panic and throw up rates by, multiple tenths of a percentage point over the course of a day. You don't want that situation to happen. And so as a central bank, you may be inclined actually to go a little bit further than you need to. You might need clear evidence of disinflation, that you're in recession, which probably means, I think, Europe, we're getting there quite soon. US probably needs to run into next year.
Callum, Berenberg has just a fabulous team with Mickey Levy in America and Holger Schmieding with his brilliant continental view. Let me take you in the United Kingdom. Is the surprise forward not from the Fed, but a blink from the ECB that has a war going on?
The ECB doesn't have the same inflation problem to deal with that the US has. The US has a strong demand underpinning. The prices are rising and they're broad-based. In Europe, continental Europe, it's mainly this energy supply issue. To the extent that Europe is in recession now, we're seeing evidence of weaker demand. Really, the ECB just needs to keep raising interest rates until inflation peaks. Once that happens and they start to see those base effects roll over, you can start to take out some of the fear and you can hold rates. So I think we're probably quite close. I don't think we get close to 3% in the Eurozone. That would be more than enough, whereas the Fed probably needs to go substantially above that.
We're all focused on politics here, and certainly the zeitgeist yesterday was the separation of economics and politics in your United Kingdom. I don't buy it for a minute. How does Governor Bailey respond to a nation staggering to 2 p.m. Monday afternoon?
Well, at the moment, there's nothing for the Bank of England to do. We had the announcement earlier this week that active QT would begin towards the end of this year. The next Bank of England meeting to focus on is the 3rd of November. By that time, the Bank of England will know who the Prime Minister is and what kind of fiscal policies the UK will be pursuing over the medium term. The problem the Bank of England has got, after what we've seen, all of the noise, the bond market reaction, it probably needs to meet market expectations in the next meeting. 100 basis points is probably what we get, which will be a doubling of the rate hike in September. But I think after that, maybe 50 more basis points in December, and then the Bank of England's probably going to be done. By early next year, it's going to be so obvious that the UK is in a recession and it's disinflationary, and there's that you won't need to go any further.
So the Berenberg call on sterling right now as we near a 110 handle once again. Where are we on sterling with that scenario?
That scenario, we're probably moving sideways on sterling, but it's going to be volatile around the politics. You might see a bit of a relief rally if, say, Rishi Sunak, he's the market favorite, wins and becomes prime minister. But the world is really suffering from a strong dollar, and understandably so. We have a major war in Europe. West is in recession. You want deep liquid US markets, so you hold dollar assets. It's hard to see until the market turns more risk on, that dollar strength starts to come out. And so we're all going to be weak against the dollar for a while. That probably is a story for next year before we start to see this position reverse.
On a Friday, Callum Pickering, thank you so much with Berenberg.
Pleasure. Thank you
for reading over the weekend. I look at this, Lisa, and as I mentioned earlier, started with John Byrne Murdoch in the FT on really questioning, as is Tim Colpin at Bloomberg, how you measure GDP in China. And he cites a University of Chicago paper that it could be half as much growth as we're actually seeing. So I've got a scenario out to think about over the weekend of they finally wake up to the anti-science of COVID, and pushing against that is all the challenges of a Pacific Rim slowdown. Which way do you go? I have no idea.
And that feeds into the idea that we were just hearing there from Callum Pickering, which is that dollar strength will persist. And this is the opposite of what we heard from Sebastian Gailey and Mark Chandler, because the rest of the world is flat on its back. And who does that hurt more? The Chinese slowdown? That hurts more Europe. That hurts more Germany. So then where does that strength come from that forces the dollar into a weaker position anytime soon that eases some of the inflationary imports of the European region and beyond?
Well, it's very emotional here. For those of you on radio, there has been imagery over the last number of hours and indeed days as well. And I think Lizzie Burden, of course, reporting from 10 Downing Street yesterday, captured this image. For those of you on radio, it's Lawrence the Cat at the podium outside 10 Downing Street, getting it done. And some humor here. You mentioned this yesterday, Lisa. The gallows humor is tangible. And of course, we missed the walk of the cat back to the door, but
yeah. Well, yeah. Someone also pointed out they put an Airbnb sign above 10 Downing Street. That was another meme that was going around. Yeah. There have been a lot of them where they try to understand exactly how quickly this story.
We will try to keep the reporting more than distant from Lawrence a cat. We can do that at Bloomberg.com UK. A terrific summary of all going on in London. This is Bloomberg.
We're going to find that this is going to be an even tougher environment than people think.
The liquidity of the market remains good.
Markets are starting to price in the idea that whatever U-turn is going to happen, nobody is guaranteed that there will be a new turn around the corner a week from now.
The reality is that hard activity data are still pretty strong.
What we're saying about 2023 is we think the first half is going to be really sloppy. That's when we think numbers come down. That's when we think we're going to be dealing with a recession.
This is Bloomberg Surveillance with Tom Keene, Jonathan Ferro, and Lisa Abramowicz.
When does something break? Welcome back. This is Bloomberg Surveillance on Bloomberg Radio and Bloomberg Television. Tom Keene, Jonathan Ferro, and Lisa Abramowicz. John is off running for Prime Minister in London. Right now, we are here with a market that is moving so quickly, Tom, that it really is hard to keep track of. Yields higher, dollar stronger, the rest of the world flat on its back.
And you've said the smartest quote into the weekend reading, which is this fear of the break, because what hasn't happened is we haven't broken. Now, these reaction functions, we're going to talk about this with Alicia Levine, but I'm sorry, Lisa, there's enough movable parts on a Friday where you have to lean in to try to get to the Asia Monday morning. Yen 152 rounded up is all you need to know.
I'm glad that you pointed to the yen. When does something break really paints a picture for Japan right now.
You never see it
Earlier
coming.
this morning, people were saying, when do they come in? When do they intervene? They've intervened before. They're not intervening. 150 was the level. We're at 151. We're above that, and it's still not really coming.
I turned away to talk to Alicia Levine about the scam known as the SAT exams, and 10-year real yield moved to a 1.80 just while I looked away.
But that's my point. This is moving quickly, even after all of the increase that we have seen in yield, even after all the reset, even after markets price in a 5% Fed funds rate for the first half of next year. How much more can we possibly do?
I think it's a movable, we got the British distraction here right now, but away from that, and you and I have been remiss on this, the data on the Bloomberg screen has really been the story of the week. Can I just mention that the Bloomberg Financial Conditions Index has gone against Chairman Powell and it's moved from significantly restrictive up to a gross accommodation, and again, 1.80 10-year real yield. That changes the discussion for global Wall Street.
Well, and this goes to the point that we've been hearing about from Mike Wilson over at Morgan Stanley. He said that expect a bear market rally because expectations are so low. Earnings will come in and they'll be better than expected because that's what they do. They guide people lower and then they beat those very low bars. And that's what we have seen with some companies. It hasn't been enough. And that, to me, is a pretty big takeaway with American Express, one of the bellwether types of companies, coming in short, as well as the shipping sectors.
Yeah, I'm going to mention it. I'm much more interested in Verizon, which has been a challenge for over 10 years, and they're talking about cost cutting of some form. I guess we're going to see a lot more of that into the end of the year.
We are seeing weakness, and we're seeing the weakness deepen as we see yields continue to climb.
There's the Bramble gloom.
Well, come on. Let's take a look at what's going on. We're down 0.6% on the S&P, and it has been heading lower throughout the morning. At one point, it was really trying to stay flat. You are seeing the euro continue to weaken. This is a dollar strength story, and that, to me, I think is pretty pervasive across the world with the pound, with the euro, with the yen, 97.47, and 10-year yields. I mean, honestly, to see just on the cusp of 4.3%. Could we see 4.5% by the next couple of weeks?
I'm looking at the real yield and not the nominal story, and it's just completely changed story. How do you write your year-end essay right now? I have no idea.
What do we do? What do we do? What do we do? Go to cash. Go to cash. Triple leverage all cash.
I think that's the title of Alicia Levine's.
Well, Alicia Levine actually joins us here without the Star Destroyer behind her. Alicia Levine, head of equities and capital market advisory at BNY Mellon Wealth Management. What is your view, Alicia, and how you view this move upwards in yield? Are we watching something break in slow motion?
So I don't think we're watching anything break, but we shouldn't be surprised at this because that last CPI print really said it all. Core inflation is now higher today than it was in 1982. Forget the top line. It's the core. And that's ultimately what central banks are looking at and what the Fed is looking at. And that's our problem. What's amazing to me is that ratchet up in yields this week, the equity market kind of shrugged it off. You would have thought there would have been a more dramatic reaction there. So I think we get something in the next few days to reflect what's happened with yields and with rates ratcheting up higher.
You are hugely adept at the mathematics of the moment. I want you to correlate the bond dynamics we're all talking about over to how you reset for equities into next year. Can you link the two beasts together, or are they non-correlated?
So I think you have to link the two together, because in this year, equities were really the caboose and the bond market was driving the train here,
Right.
which I get teased about,
No,
blaming the bond market. But it is true, because your multiples get compressed when yields and rates move higher. What the market is doing is pricing in an over 5% Fed funds rate. You're going to feel it on the equity side. You can't avoid that. It's all one system.
Okay.
You don't have assets that just trade on their own. It's against the risk-free rate.
But in a log Euclidean space, or even if you go to some fancy XYZ space as well, is it non-linear from here in the dynamics of the bond market pushing stocks around?
So that's a really interesting question. You're asking, has the work been done? Right. You're asking, have we had enough multiple compression? And I think the answer is the direction is still in a volatile way. But I do think a lot of the multiple compression has already been taken care of, because if you think we're headed into recession the first half of the year, you're going to wind up with lower yields eventually. And that, in a weird way, is going to support the market. Also, the earnings season is coming in, Lisa, as you pointed out, better than expected, in part because of inflation, in part because we had the financials report, and so they're doing well on net interest margin. And, the high-end consumer is spending. Think about Nordstrom's. Think about LVMH. And travel. So people are out there spending. It's not a total collapse yet. So you could have some stabilization as you have two-year yields move higher.
So what happens first? The Fed blinking, or seeing yields kind of get out of control and cause some sort of torpedo effect in the multiple valuations?
So I don't think the Fed blinks. Okay, so the Fed will blink if there's an event. And right now, the UK walked back from their event, which walked back the event on the global bond market. And they seem very intent on getting higher here. And they've really trapped themselves, right? They've trapped themselves because they keep on talking about CPI, which, as you know, is backward looking, because they want to signal to the average household that the Fed is on the inflation job. Backward looking. We still haven't seen the effects of the rate hiking cycle for another 6 months. So, you have signs, housing's rolling over, you have signs of a slowdown, but the Fed's out there hiking with old data.
Meanwhile, taking a look at what we're expecting from earnings, we get some of the big tech names next week. We have seen Snap. That was concerning, and it's been very concerning this morning for owners of Meta, which already has tanked. Facebook has lost a significant portion of its value. How much more do the tech bubbles have to burst at a time where they've already been devalued dramatically?
So high growth names, when they stop growing high growthly, get not only an earnings downgrade, but you get the multiple compression as well. So to the extent that you have stocks that are still trading at 40 times next year's, the tech names are still too high. Ultimately, those names have not been driven down dramatically.
I got to slip this in. If there's a factor adjustment into 2023, and I'm really big on the zombies that are going to be taken out in this new rate regime, what do the non-zombies do, and which factors matter next year for the profitable non-zombies?
So there will be a wave of M&A coming from the non-zombies, and cheap, right? You're going to have really fire sale of companies here for IP as well. You could have M&A just for IP in some of these sectors. But, ultimately, to the extent that companies raised cash during the time of near zero rates, you should have some resiliency there. I think the credit cycle happens in the private markets, in those middle markets where they couldn't quite raise the cash because the corporate America is flush with cash right now. The refinancing there is not going to be the problem. And ultimately, the American consumer, I was looking at the unemployment data yesterday, the new claims data. I mean, we're at rock bottom.
Yeah,
there is not a problem in the labor market here. So, you have this weird push-pull where you're getting the bullwhip effect on inventories, and you've got labor working and spending.
Yeah. Alicia Levine, Too Short, thank you so much for being with us. Alicia Levine of BNY Mellon Wealth Management. That is one of the most fascinating points, Tom, this idea of the private markets being where the big reset comes. And we heard from Harvard's endowment, and they actually said that they outperformed what they actually expect to have done in retrospect because they haven't yet seen the big markdowns in the private markets from some of their managers.
I like what we heard earlier this week where we go back to alpha, where individual security selection, bond and stock, really begins to matter. I can't emphasize enough the percentage of people out there that have never lived a Sharpe ratio, a legitimate risk-free rate into the risk-reward calculation.
Who've lived by indexes, who've lived by blanket buying.
They've lived by the great disinflation.
Right.
It's gone.
And so now what happens when you get a credit cycle in assets that you actually have to look at, right? I mean, that's what we were just hearing from Alicia. And I thought this story was interesting. Apollo and JP Morgan are working on building out secondary trading of private credit because they're anticipating the same kind of thing. And there's been some reporting on that because they expect that to be.
They're going to trade Bitcoin?
Well, I mean, I guess.
What I would say is in the 8 o'clock hour on a Friday, we have Alicia Levine over to Steve Major of HSBC, and that's what the show's all about.
Absolutely. Steve Major has been really out front, and he's going to have a pretty controversial call. I don't think he sees up and away for yields the same way that perhaps Larry Summers does.
No, it's going to be fascinating. Plus, he's got to talk about Aston Villa and Steve Gerrard out the door.
Well, I will let you spearhead that
I'll have a monologue on that because where the hell is Ferro, right?
You're going to have a monologue on that coming up, hopefully without just too many monologues. Stephen Major, Global Head of Fixed Income Research at HSBC. This is Bloomberg.
Keeping you up to date with news from around the world with the first word, I'm Kriti Gupta. Biden administration officials are said to be discussing whether the U.S. should subject some of Elon Musk's ventures to national security reviews. Sources say that would include the Twitter deal and SpaceX's Starlink network. U.S. officials are uncomfortable with what they see as Musk's increasingly Russia-friendly stance and his plans to buy Twitter with foreign investors. Ukraine's foreign minister says he talked with Israel's prime minister about Kiev's request for defense systems to help combat Russian missiles and Iranian-made drones. Israel has offered to assist Ukraine with a missile warning system, but says it will not provide weapons. The U.S. has accused Tehran of sending trainers and technicians to Crimea to support Russian drone attacks. American Express has slumped after it set aside more for bad loans than analysts expected. It suggests rising interest rates could start hammering customers' abilities to pay their bills. Provisions for souring loans were $778 million in the quarter, worse than the $573 million analysts in a Bloomberg survey were expecting. The European Union has agreed to press ahead with a set of emergency actions to address the bloc's energy crisis. It comes after Germany yielded to pressure from other member states to pave the way for a temporary price cap on natural gas. The European Council's president says the move sends a clear signal to the market that the bloc is ready to act together. And Credit Suisse will aim to settle a tax fraud and money laundering case in France on Monday. The Swiss lender is reportedly in the final stretch of negotiations with prosecutors to reach an agreement that would include a fine but no admission of guilt. The size of the settlement is unknown, and the deal could still fall apart ahead of the court hearing. Global news 24 hours a day on air and on Bloomberg Quick Take, powered by more than 2,700 journalists and analysts in more than 120 countries. I'm Kriti Gupta. This is Bloomberg.
I think that as we move forward, we're going to find that this is going to be an even tougher environment than people think. And I've been advocating something I've been advocated for a long time. This might be the return, to use the Wall Street term, alpha. This might be the return of stock pickers and bond pickers
Tough. That was Jim Bianco, president of Bianco Research. Tough today in the FX market. Bonds on the move, currencies on the move, and it is a strong dollar. It is weaker bonds across the world. Yields up. Tom, things it feels like are starting to break around the edges.
Right.
With right now the Japanese yen at 151.8.
We're going to dive into this with Steve Major in the next half hour, but to take 30 seconds and steal it from Ed Ludlow on Twitter right now, we are at a moment here. I can't say enough, folks, looking at the Bloomberg terminal, the critical breakage points here on the Bloomberg Dollar Index, which shows, I'm going to talk pro talk here because it's that important. Short-term convexity on Bloomberg Dollar Index taken log. I see the yen breaking out with new velocity towards a 152, and sterling, with all the politics going on, Lisa, is absolutely textbook short cable. Textbook chart short cable right now.
But how much is this really being driven by the dollar story and the yield story? And I say this because, yes, the UK has been a train wreck in terms of the political turmoil. However, you're not necessarily seeing this just only isolated to Great Britain. It's also the yen. It's also
It is
Europe.
absolutely global. And I got to stagger back to one statistic here before we get to Twitter. 1.81% on the U.S. 10-year real yield. That is moving. That is almost to the phrase leaping logarithmically up, and from a 161 to a 180, maybe that's the one statistic that helps.
We're talking about how quickly yields are moving on the flip side of the dollar and the real yields, the nominal yields,
10 basis points,
4.33% for the 10-year Treasury yield. At what point do we end up with something that really is a game changer in terms of longer-term expectations?
Keep you abreast of this, and of course, looking into foreign exchange is the deepest part of the market. The deepest part of Elon Musk's market is, well, maybe it's not going to work. A number of items out this morning saying he may have another cash call to finally get this transaction done. Edward Ludlow joins us right now, expert on all this. I think there's 4 Musk stories this morning. Which one matters for his ability to get this transaction done?
Yeah, the Bloomberg report that DC is antagonized by him.
This is about Biden, National Security
Council. Yeah, so Bloomberg
Council,
reported that according to sources, his recent behavior and commentary around the war in Ukraine, about his brief threat to remove the Starlink connectivity services that he was providing to help the efforts in Ukraine, and also just simply the deal to buy Twitter. Our sources tell us that across a range of government agencies, they're thinking we might take a look at this. Now, by the way, public service announcement, the White House has this morning said that it's not aware of any review of Elon Musk's security clearance or any security review of his businesses. But clearly they're thinking about it. This isn't the first time it's happened. 2019, he goes on the Rogan podcast, smokes marijuana. He also leads the biggest private space company.
Come on. You're not going to equate marijuana with a guy who builds technology which helps Ukraine in battle.
I'm not. All I'm saying is that this discussion around Elon Musk's behavior and his security clearances. Remember, SpaceX provides services not just to NASA, but to the military and the Pentagon. But also, he's a big contractor, right? And they simply said this is not behavior forthcoming or fitting for somebody who has this level of security clearance. The bigger issue around the deal is this. Ironically, we'd reported things going pretty well. Bankers on both sides working. The bank's getting ready for the debt call to come in, right? And then this comes out and it throws the deal into doubt, and you see that reflected in the market.
This is a distraction. Let's be honest, because Twitter has been an ongoing distraction, a story unto itself with the Elon Musk kind of hubbub, but it masks the real story even at Twitter, which is that they were planning cuts at the company even before he got involved, that this was a company that was really struggling. And you're seeing that not just with Twitter, but the social media facing tech companies more broadly, as we saw from Snap. I mean, how much have we seen the reset already take its course versus have more to go?
Go back to what Jim Bianco just said on this program. The shock is greater than we expected. Actually, we thought the softness in the advertising market was done with. After the war in Ukraine and in Europe in particular, we had the commentary from Alphabet, parent of Google. We had the commentary from Snap actually already.
Yeah.
But the wording in their earnings statement was so specific. A pullback in spending by advertisers. They're decreasing budgets, and all of these names are fighting for a small pool. Why is it important? It's actually a pretty good lens into the macro picture. Advertisers pull back their spending because consumers aren't spending. Why? They're hurt by inflation.
People are probably not interested as much in tech right now because they're looking at markets and they see, hold on a second, and they see yields moving dramatically. But this is part and parcel of potentially a similar story. The free money is over and tech is going to be reeling, and that is what we're seeing right now play out.
My eyes didn't light up just because I'm interested in tech and I'm trying to justify my existence. But, I take Citi, for example. They have this call where they're overweight global tech. Why? Look at the specific names, the one with the strong balance sheets, with the entrenched market positions. When you're trying to work out what to do in an earnings season and where earnings on an EPS basis will hold up better than other corners of the market, there is a thinking that actually, yeah, of course Apple's going to fare better here. They're more nimble. They've got the cash to flex. They're smart about how they handle the economy globally. So there is some optimism out there around global tech being a better play, almost like a defensive stock.
Yeah.
Do you buy that theory? I don't know. But there is some corner of the market that believes that.
We'll perhaps find out. Ed Ludlow, thank you so much, of Bloomberg. We'll find out perhaps on Thursday with the earnings. Right now, stocks and bonds very much on the move, yields higher, and the dollar really preeminent, Tom, around the globe.
Well, when Bruce Galbraith tweets in and says, Tom, give me a DXY quote. I don't have my Bloomberg with me. Bruce, good morning to you. DXY 113.86 out to 114. 115 is an unimaginable print. And I'm going to go right back to the IMF meeting where on camera and off camera, it was the same thing. They're watching swap lines, which is the borrowing of overnight money, think Friday, between major countries, including Switzerland. It's confusing, it's advanced, and critically, the nations that do not have available the ability to go out and borrow gajillions of dollars overnight, that don't have swap lines. And I'm going to say that these are the shadows cast right now by the rumors, the speculation, Lisa, about the unknown of swap line discussions of the IMF and all the major central banks.
Are you suggesting that there's some sort of backroom negotiation that has to be going on?
No, I'm not saying backroom. I'm saying I'm looking at the Bloomberg screen on a Friday, and it's giving me all sorts of information that there's something going on out there. I don't know what it is.
I think that there is something going on. There's yields higher, and there's the dollar markedly stronger, and even more so as the moment goes on. And I do have to keep coming back to the yen. We had expected intervention. It has not come yet, at least to the satisfaction of markets, with a pervasive weakening in the currency as they stick by their yield curve
Their
control.
goal is control there, and the way you get control is Saturday, Sunday into their morning. Stay with Asia and Bloomberg Radio and TV here on Sunday.
And Stephen Major, he's coming up. Cannot wait for that discussion. This is Bloomberg Surveillance on Bloomberg Television and Bloomberg Radio. Tom Keene and Lisa Abramowicz. John Ferro is not really running for Prime Minister. He is off. We are seeing markets on the move. Stocks lower at session lows, down 0.7% on the S&P, down 0.8% now on the S&P. Euro at 97.14, weaker versus the dollar. Yields really are, to me, the driving force. Yes, it is a dollar story, but it is also very much a yield story with 10-year yields at 4.32%. Real yields crossing that 1.8% level. Tom, to me, this is a market that is facing some sort of reckoning. Have people gotten over their skis with how high yields can go?
What surveillance is about is you get lucky. And we got lucky yesterday with terrific work, particularly with David Merritt, who led all of our Brexit coverage ages ago. And Lisa, I thought it was just great yesterday to have everybody, Micklethwaite and the rest of them, weigh in on the absolute chaos there. You think we got lucky this morning?
Without a doubt, with bond vigilantes in the front seat, huh?
Dragging himself back from Hong Kong, Stephen Major joins us now with HSBC, Global Head of Fixed Income Research, and we're thrilled he could join Bloomberg in our New York studios. Forget about all the market talk here. What is the experience of living in Hong Kong under quarantine?
It's getting easier, Tom. Much easier, and I can't wait to go back because we're free now. There is no quarantine. So I've done my time now.
You think they can salvage their relationship? I don't want to get you in trouble with HSB management, but you are optimistic they can salvage their relationship with Western banks to stay a financial capital?
Yeah, I think all the moves are in place, and November is a big month. Many people are going there, so yes. Yeah.
We are thrilled you join us for this entire half hour. You are known as someone that has said price up and yield will stay down. We've seen a major adjustment here. What is the new major look on how yield finally crawls lower and price higher? When do we get there? How do we get?
Don't you have a show called Real Yield?
We do.
Is that one of John's ones?
Yeah, I'm moonlighting this afternoon.
You're doing it. Well, at least it's relevant now because you actually do have a real yield.
No, it's relevant because Lisa's doing it and John's not doing it.
Actually,
but continue.
Yeah, let's have fun at John's expense.
24/7. Continue, Mr. Major.
But if you can get real yield anywhere near 2%, that covers real GDP. So if you're building a portfolio from scratch, and you know this is without being encumbered by all of the carnage in markets the last few months. If you're building from scratch, 2% real yield covers GDP in the longer run. So we don't know where inflation is. It seems to be a good place to start building a portfolio with a real yield close to 2.
So let's just put this into something that's very clear. Do you see 10-year yields at 4.3% in the U.S. as a screaming buy? Load up because we are not going to see yields like this again.
Yeah, well, fortunately, I work with some professionals who contain my enthusiasm because I would have been buying every week, right? So that's why I'm not a trader. But the point is the valuations today show a very strong recency bias. I mean, I can honestly believe that yields will keep going up in the near term, but you could also build a plausible scenario that there's a hard landing and that yields should be less than 2%. You could build that scenario. The question is, what weighting do you put on it? Right. So at the moment, we're pricing a very high probability of the Fed going to 5 and staying there forever, which just doesn't seem plausible.
Well, a lot of people, and this is something that I was really excited that you were coming on to push against. What I'm hearing increasingly is that there is a stickier, more pervasive inflation over the long term, and that the Fed funds rate is not going to go below 2% anytime in the next decade, simply because of the deglobalization or the localized globalization, some of the population trends, and some of these other macro factors.
Yeah, I don't think the longer term picture has changed, Lisa. Demographics, debt, wealth inequality. The explanations for low R-star have not reversed. I think you can give me some arguments that maybe underwrite or underpin the R-star, but not reverse it. I don't think you can reverse the pre-pandemic trend.
Just to quickly follow on to this, then do you think we're going to see 0% rates in the next 5 years?
I think you'll get a hard landing, and the probability of the market pricing a return to the zero bound cannot be ignored. So it's all about probabilities. The markets are pricing rates at 5, right? So the 2-year yield can be 100 to 150 over the current money rate. In an easing cycle, the 2-year can be 150 through the money rate. So that's not happening this week, but sometime next year, the market would not be wrong to be pricing in an easing cycle.
I got a zillion angles here. If you're on radio, Stephen Major with us with HSBC for this entire half hour. And the one angle I want to talk about is you mentioned the breakage that could be there, and what we're observing right now in the markets, DXY getting up near a 114 is without question the focus at the IMF was on swap lines.
Yeah.
Is it enough of a power in the foreign exchange market to see dollar strong, where there's a swap line demand or a desire for swap lines, even if I can't get them? And is that enough to make Jerome Powell blink?
There are a number of economies in Asia where there's been a tightness in the funding markets recently, and looking ahead to year-end kind of pressures. Yeah, we had a fire drill with the UK, which showed what lessons did we get from the UK? Fast moves are dangerous. It isn't just the level; it's the speed, right? So I wouldn't be surprised if the Fed was watching that very closely. Was there a point a week or so ago when people were worried? You see, at the moment, what happened in the UK wasn't enough to distract the Fed from its hawkishness. But who's to know if something spills into a market somewhere? And in fact, it'd be wrong of me to speculate, but there are so many pools of leverage in the global economy, so many areas that need to refinance. And when the dollar is moving like this and the rates are so high, the spreads are so wide, there's going to be some pain. So I don't want to come on here and speculate as to where it is, but you're right. The swap lines are being looked at because there's tension. Do
we have good data now? John Byrne Murdoch, first thing I tweeted out today over at the FT with a fabulous essay on the opacity of Chinese economic data. Do you feel sitting at your desk in Hong Kong that you have good Pacific Rim data, that you have good global data, or are the tensions germane as you see in the swap line debate?
I think we're always struggling to catch up, Tom, and we're all experts about LDI now in the UK, but we weren't before, were we? Like, we can all quote numbers and talk about what happened. But
Can I do a shout out to Jordan Rochester? Nomura just killed it. I found a Nomura paper from 4 or 5 years ago on LDI that absolutely nailed what was going to occur.
So we're all experts in LDI, and we're also all experts in British politics. I'm wondering, as you talk about the speed, and this is something people have been talking about, what happens to 10-year Treasury yields if Japan abandons perhaps its peg or has some sort of failed intervention, as we see almost 152, 151.9 right now on the dollar versus the yen?
We're trying to game this one out. With US yields here, if the YCC was changed, if there was an iterative shift, it would have much less impact than where yields were 1 year ago. So if Japan had changed its policy, global fixed income could have been de-anchored a year ago. If they were to do it today, it kind of doesn't matter so much because they're going to be adjusting into a bigger spread because US yields are so high compared to Japan. So the Bank of Japan estimates that the 10-year JGB would be around 80 basis points if there was no YCC. But this isn't black and white. Right. It's not going to be no YCC. It's going to be an iterative shift. Yeah.
What you're saying, though, is important, which is we've already done a lot of the work to reduce the shock value of how quickly the moves can be. Does this mean, perversely, that you end up with yields higher for longer because there isn't some sort of trigger that causes some sort of monetary policy to step in?
Higher for longer? Well, that's a good one. So is that the opposite of lower for longer?
Yeah, exactly. Well, we saw that for a long time.
I think that when you've had a once-in-a-century pandemic and all the other supply-side shocks that we've had, we shouldn't expect a return in the space of a year to what we had before. Right. It's a multi-year process. I think that 3 to 5 years out, we'll be back where we were in 2019. Right.
You're going to be with us for the whole half hour, which is really, really great. We're thrilled by that. John from Glasgow emails in and says, soccer talk time with Steve Major. Noel Quinn comes in today. Noel, thank you for watching HSBC. He says he's paid for you to see 4 Premier League games in the last 10 days or something. What'd you observe here? And give us an update on West Ham and the rest of English football.
I was very lucky when I was back in the UK. I saw 5 games in 8 days. At West Ham, which is my club, and I also went to Arsenal. And it's just fantastic. The quality of football is just getting better and better every year. It is amazing. It's such a privilege now to go to games.
That's what John Farrow says exactly. Can star players be good, what we would call coaches or managers? Gerrard out at Aston Villa. Yeah. Is it just too hard for a player to do that?
Well, as we know, Steven Gerrard was a superb player, but I think the step into management is difficult because how do you motivate and manage these multi-millionaire players just because you happen to be a player yourself? I mean, management, as we know, is a particular skill. The guy that runs Ford doesn't have to be an engineer. For example, right? Yeah. And so you see someone like Mourinho. He wasn't really a player, but he's one of the best managers of all time. So, I think Steven Gerrard's an interesting case study.
Was that enough soccer talk there, Lisa?
Sorry, I'm looking
I'm looking
at yields. No, I'm looking at yields, which have been really on the move.
We did that for John. We missed John. You know.
Well, it's so obvious that Lisa's not interested.
You have no idea. You have no idea. With that, we're going to save the half hour and come back here with Steve Major. Lisa, take us out, but I'm sorry. I've got velocity on dollar strength here that's extraordinary.
113, almost to 114, really. And I will just say, I think it's awesome. It's just a foreign language to me. You have to be following it, and then, if you're not, then it's hard to know. But I am following the bond market.
Lisa,
yes.
It's a foreign language to me. I just fake it.
Do you want me to try to fake it? I think people would cry. I think that they'd put a cat up at this seat instead of me in front of 10 Downing Street. Right now, we are watching the S&P lower by 0.8%. And you can see that yen really close to 152, 151.93. This is Bloomberg.
Keeping you up to date with news from around the world with the first word, I'm Kriti Gupta. The White House says they are unaware of any national security review for some of Elon Musk's ventures. It's been reported that U.S. government and intelligence officials were weighing in on the possibility of using tools to review Musk's multiple ventures. Those ventures were said to include the Twitter deal and SpaceX's Starlink network. President Biden has started aggressively promoting his student debt relief plan. The government has been working out kinks in the program. A White House event Monday is set to officially launch an application website. Meanwhile, multiple legal challenges, including a lawsuit from Republican-led states, are moving through courts, threatening to halt the effort. China has locked down parts of a central city, confining some of its 13 million people to their homes for at least a week. Other major hubs are rolling out virus restrictions as well, reflecting the country's commitment to its COVID-0 policy. Residents in high-risk areas are required to stay at home until no new infections are reported for 7 days, and they get moved to medium risk. Italy's Giorgia Meloni has clinched a mandate from her coalition on the path to becoming Italy's first female premier. The coalition, which includes her Brothers of Italy party, former Premier Silvio Berlusconi's party, and Matteo Salvini's League, told President Sergio Mattarella that she is their candidate. Mattarella is expected to formally ask her as early as Friday to try to form a government. Kering posted slower sales growth than luxury rivals LVMH and Hermes during the third quarter. The company's Gucci brand was said to be held back by China's continuing COVID-19 restrictions. Kering CFO told analysts the Italian brand's revenue from the mainland declined during the quarter, and the situation there is still not back to normal. Global news 24 hours a day on air and on Bloomberg Quick Take, powered by more than 2,700 journalists and analysts in more than 120 countries. I'm Kriti Gupta. This is Bloomberg.
I would not be surprised how fragile financial markets are, that the Fed has to pause to get them back under control. The U.S. financial markets are in a good place right now, but if nothing else, the UK has shown us how fragile to an event, to a bad policy decision. So I don't feel confident about what they're going to do in December, let alone where we're going to be by June of next year.
She is a former Fed economist that barely describes the academic contributions of Claudia Sahm. She's controversial. With us today on the Fed, and she, not only that, she has her own ratio, if you will, the Sahm measurement of recession, which you can see throughout all the Fed system. She's had really quite a splash academically, and then linking it over to all the punditry that we see each and every day. We welcome you to Bloomberg Surveillance on radio and television. And what a joy, some quiet moments here with Stephen Major of HSBC in a very unquiet time. My study, and this goes back to Martin Feldstein of Harvard, is that these things end stochastically. Things move, and they don't level, they don't plateau, they get pointy, they turn around in reverse. What is a stochastic event that will allow some of the carnage I see on my screen to reverse?
That's right, Tom. I think that it might even be a bimodal market. So you've got one mode that's got this strong recency bias, and then there's the other one that prices in an event. I mean, the facts are that the median number of months between the last hike and the first cut, based on the last 70 years of data, guess what? 4 months. Mm-hmm. The mean is 8, so it's skewed because of the 2006, 2008 period. But my point is, you just look at the numbers. Once they've hit the peak, the market is not wrong to be looking over the other side. And what's the event? Well, the UK could have been, if the UK event of fast-moving yields and disruption somehow affected the US financial markets. I'm talking here about money markets or mortgage markets, or you said swap lines, all this stuff. Who knows? That makes the Fed think twice about going all the way to 5 or above.
You're living in Hong Kong, you're living the anti-science of China. Fine. The anti-science of monetary policy is Japan. Everyone knows this. What are the ramifications to the Steve Major world when they capitulate on YCC in some face-saving form and you get yen 152 to 129 over literally a cup of coffee?
Yeah.
What happens to the system?
I don't think you get the shock that you could have had if they'd changed YCC a year ago. Because of where US yields sit today, they're so far above. So they can soak up easily a Japanese move. I imagine that the Japanese curve would flatten. So it would be a bear flattening because the curve is so steep between 10 and 30 years. Now, in global fixed income, that's not gone unnoticed. If you're sitting in Germany you can switch from your local market into JGBs and pick up yield because of the curve steepness and the hedging. Because Japanese rates are below zero at the front end, whereas ECB and Fed are hiking. So there are opportunities here in global fixed income from the divergences.
To go to your arch thesis, as they manufacture what I'm going to editorialize here and say a pseudo-inflation, are we essentially going to have a stochastic move back to disinflationary trends in the arch major theory, which is some forms of deflation?
I think so. And from a Japanese perspective, if you've waited 30 years to come out of deflation, a couple of months of +2, +3 doesn't do it. And that's the Kuroda approach. We don't know who Kuroda's replacement is going to be. He or she won't be in place until next year. So it's just speculation on our part. And I feel very much that's all we're doing. Right? We're trying to game it out anyway.
And now, folks, we dive into our World Cup coverage. We do this without John Ferro, which is unfortunate. You, of course, have a global mandate. You're going to be in the Middle East. I guess you're going to attend the World Cup. Can you explain to mere mortals like me how we see a good product with 86 degrees on the field?
It might be a slow game. It could be completely different. I mean, I'm going to go and see some England games. I'm lucky enough to get tickets, but I think it's going to be a strange World Cup. It's going to be surreal because in that kind of heat, it will be a lot cooler than it is in the summer, obviously. But the game's going to be slower and I guess more measured. It's not going to be as crazy as the Premiership because you've seen how fast they play in the Premiership. You've seen it yourself. Yeah.
On sterling and gilts, let's finish there. I've got a 110.84. We've moved a full stick here on sterling this morning, 112 down to 110.87. It's inappropriate for you to comment on the politics, but please, on the pressures that Governor Bailey faces.
Well, he's reiterated the independence, and I think he's been pushed into a bit of a corner. I mean, it didn't help that the Bank of England was hiking at a pace less than the Fed before the events in Downing Street. But the Bank of England's role is quite interesting here because they are buyer of last resort and they've shown their ability to do that. And I think the gilt market has actually calmed down quite a lot. And one of the big differences between the UK and US is that things can happen very, very quickly in the UK. All of those fiscal proposals have basically been abandoned.
Could you be long 10, 30-year gilt this morning? Price up, yield down?
I think you can start to look at it, and I'm interested in how gilts look compared to equities, for example, and there will be a lot of fund managers looking at those relationships, so bonds versus equities. It's the same in the US. There's a point when you have to start favouring bonds over the risky assets, and I think that's. Ultimately, for the Bank of England, it's they've got the QT, they've got the QE, they've got the policy rates, they've got to work with the DMO on patterns of issuance, which could be modified. I think that the worst is past us now, and I think we'll probably see a period of calm after the shock.
The period of calm will come after your view forward for 2023. A theme for 2023 that we may see written by HSBC.
Yeah, I'm not going to front run the research because we haven't published it.
It wasn't, did you hear that, folks? I didn't hear that. I don't know
we haven't even sat down. I think we'll be pleased to get to the end of this year.
Try to get to the end of the month. Stephen Major, thank you so much. Greatly appreciate it this morning. He is with HSBC, and this is what we try to do to bring you the conversation on this in settled times and decidedly unsettled times as well. I have a minute here to summarize what we've seen this week. It is absolutely extraordinary, and please stay with us through the weekend as we stagger to the Asia morning, 7 p.m. Sunday here in New York. Let me go to the deepest market, foreign exchange. You can see that with DXY dashing up near a 114, a 115 print on that major trading index series. That would be extraordinary. Euro doesn't give me any information today. Sterling simply weaker against all that we see to Monday morning. Thank you, Tom McKenzie, outside Parliament with 110.93. Even dollar Canada looking 138, 139 is extraordinary. Oil not part of the story today. And equity futures, a little bit of a weight to the tape here as we stagger 30 minutes to the open. Please stay with us through the morning. This is Bloomberg.